Treasurer Eichenberg. Secretary Romero. Present. Tim Jennings. Mr. Jennings let me know that he may not be able to join us. He had a family commitment. Harold Lavender.
Present.
Lee Rawson.
Present.
Mike Messina. Nicholas Hayes.
Here.
Kathy Allen. Here. John Bingaman.
Here.
Let me just go back and see Mike Messina.
Here.
Thank you, Mike. You do have a quorum, Commissioner.
And did I hear the treasurer? Is he on?
Yes, the treasurer is on. Are you not, Treasurer Eichenberg?
Let's move on to approval of today's agenda. Do I have a motion?
Is Harold still move?
Okay, do I have a second?
I'll second.
We have a motion by member Lavender and a second by member Allen. All of those in favor of approving today's agenda, please say aye.
Aye. Aye.
All of those opposed? Any abstentions? Okay, with that, we have unanimous approval of our agenda. We'll move on to agenda item 1C, approval of last month's SIC minutes from May 25th. Any questions or comments on those minutes? Do I have a motion?
I'll move.
I move the state. I'll second.
All right, so we have member Romero with a motion to approve the minutes, a second by member Lavender. All those in favor of approving last month's minutes, please say aye.
Aye. Aye.
Any opposed? Any abstentions? All right, we have unanimous approval of our May 25th minutes. Let's move on to agenda item 2A, which is the SIO report. We'll turn it over to Mr. Maurice.
Hang on, Madam Chair.
Is that member Rawson?
It is. I don't want to slow things down, but I do think we should make sure we have roll call votes on matters that affect investments and policy. Just
great.
minutes in the agenda.
Minutes agenda.
Thanks.
Roll call votes on our investment matters today. Sounds good.
All right, everybody. Good morning. This is Steve. To have you all on the call with us. Hopefully we'll be together again in August with no meeting in July. Let's first touch on item A on my briefing, and I'm going to add one thing to it, which I think fits very well. June 2021 total distributions for the last 12 months from our funds have been $1,070 million. Our net asset value, as last reported by J.P. Morgan, $33,611 million, and I'm rounding these numbers. West Texas Intermediate was most recently at $73.66, with our New Mexico price at $68.19. And we are receiving interesting communications, particularly from Bank of America, predicting $100 oil this year or next year, either the end of this year or next year. We shall see. The rig count has improved. From June of 2020, the number of 54 rigs in New Mexico, to June 18th of this year, 75 rigs. I think it's also good to add at this point the state land office contributions to the funds. Brent usually reports on this. but I think the data fits better here. The monthly contribution from the state. I'm sorry, go ahead.
I said you're going to steal Brett's thunder.
Well, yes, I am. If Brent wants to do this again, he's certainly welcome to do it. State land office contributions have been phenomenal. The monthly contribution is $115,307,000. That's a $5.5 million increase from April. That's the May number. And as you know, those lag. And for year-to-year comparisons, our May 2020 contribution was $93,500,000. So thank you, Commissioner, for the good work you all are doing and for those who provide you with those funds. Any comment on that, Commissioner?
Where do you see next month?
We can't wait. Moving on to the next item on my briefing, you'll see that today the council will be considering an ESG policy draft, and it is just that. We have not proposed a vote on it this month. Your staff, our consultants, and RBK, obviously one of our consultants, have been working on this for the past 2 or 3 months. We've gone through several iterations, and what you see today is the most recent. Today, if you will, members, I think it might be wise to just discuss this draft. Let us know if you wish any changes, and then we could vote in August if that is acceptable. And we've asked RBK to make a presentation on ESG. They did an excellent job doing that with the investment committee, and I think the council will appreciate it and learn from it. Moving on to council matters, item C, as you know, and as I mentioned earlier, no council or committee meetings in July. And we've listed the August meetings for you. Under operations, recruiting, sourcing, staff. We continue to look for a financial analyst for Brent's group. David and Brent have found an IT professional who they are working with as a temp, and it's possible that this person could move into a more permanent role. We are continuing to look for a public equity analyst for Starla. And Carrie will be leaving the SIC at the end of August, retiring. That's exactly what we all feel. Thank you for emoting. Carrie has done a magnificent job for us over the years that she has served us so well. She deserves to have some time with herself and John and her family. And we are looking for someone who can step into that role. I can't say step into her shoes, but step into her role.
Steve, I'm wondering if there are members that want to thank Carrie for her service at this time.
Please.
So if there are members who want to speak up. Yeah, Harold.
This is Harold. I'll start off. I just can't imagine the whole, I've been here quite a while, and I can't imagine this whole operation without Carrie. Steve and the rest of the staff are going to have their hands full. And you are wonderful, and I'm really sorry you're leaving, but I get it.
Hi, Madam Chair. This is Mike Messina.
Member Messina?
Yeah, I just want to say it's just been incredible having Carrie, throughout my time on the council. You're just an incredibly greatly.
I want
This
the
is Kathy.
council. Go ahead.
This is Kathy, and I'm new, or at least back on the council. And Carrie has been so helpful in just getting me acclimated and the all of the onboarding and helping me with figuring out what I needed to file. And you're going to be sorely missed. Really, really sorry that you're leaving, but I know what it's like to have some more time with your family. So sorry about that. Thank you.
Yeah, this is John Bingham, and Carrie, I just congratulate you on a fantastic tenure, and I got to see how integral and important you are to the operation there, and I second Harold's comments. I think the rest of the team's going to have their hands full trying to manage through without you, but congratulations to you, and thanks for all your help.
This is Member Romero, and Carrie, I just want to thank you for your service. It's hard to find people that are committed to public service, and you are one of those. And it's as hard as it is for us. You deserve to go out and enjoy retirement. So we wish you the best, and hope that our paths will cross sometime in the future.
I want to just mention to all of you that one of the more difficult tasks we've had with drafting a position description is trying to list all of the things that Carrie is responsible for. And I still don't think it's very thorough. We've done our best at it. Carrie's taken many shots at it, so have I. And trying to find a professional of Carrie's abilities to fill this role is going to be extremely difficult. Thanks to all of you for your comments, and Carrie will at least be able to work with you through the end of July. Thank you for all you've done. As all of you know, we've worked remotely since March of 20. The governor and the state personnel office have published guidelines for telework in the future. Our management group will be getting together in person tomorrow to review those and to design an appropriate return to office plan, for lack of a better word. The governor and the state personnel office have allowed us considerable flexibility in preparing this plan, and we will put together a responsible, acceptable way to work as we come back together. Certainly we'll advise the council as soon as we have something designed. Under external relations, Charlie put together an excellent slide deck, which I think I may have mentioned to you earlier, which was presented to the Investments and Pensions Oversight Committee on the 21st. We made a very brief presentation, no more than 1 minute. The IPOC then spent most of their meeting deciding what their work plan should include for the interim, and it was a brief meeting, and our involvement was limited. Please take a look at the slide deck, which has been included in Charlie's weekly emails. For those of you that don't have it, it's about as good a brief educational piece as I think we've had. So thanks for that, Charlie. And now, since we have mentioned his name, Charlie, if you would step in and brief the council on the Recovery Fund, the Small Business Recovery Act, and any client matters, that would be appreciated.
Sure. Thank you, Steve. So the New Mexico Recovery Fund has completed its investment period and finalized the last of the legal agreements. Ultimately, 29 loans were awarded from the council's fund to 28 different entities. Those included local businesses in Albuquerque, Santa Fe, Las Cruces, Taos, Rio Rancho, and Farmington, for the total of $87.75 million out of the $100 million that the council dedicated. We feel pretty happy with that result over the last year. Now it's just a matter of getting those businesses going and getting those loans repaid. Client matters, we continue to see some strong interest from potential clients, and then also some interest in existing clients putting additional dollars with us, and also perhaps more clients venturing into the private market pools. Currently, only 2 clients out of our 23 are participating in that, but given where market valuations are rather currently, I think we're going to see some more interest in greater diversification and accessing those pools. Steve, I have nothing else. I would like to say that we are going to miss Carrie. It's a very big loss to the office, and so thank you, Carrie, for what you've done over the years. Steve, back to you.
Thanks, Charlie, and Commissioner and Council. That concludes my report.
All right. Thank you, Mr. Moise. And Charlie, any questions for the State Investment Officer? With that, we'll move on to the Chief Investment Office report. Mr. Smith.
Thanks, Madam Chair, and good morning, all. Today we've got a pretty active meeting for you centered around performance reporting. We'll discuss April's numbers in our monthly report and then turn to the quarterly reports for National Private Equity, the New Mexico Private Equity, our real estate portfolio, and the real return assets. These four reports, the numbers are for calendar year end, which typically they come in late, primarily due to time-consuming and year-end auditing at our manager. So the numbers will be a little stale, but I think you'll be impressed. There's some very strong numbers in those reports. I hope you have a chance to at least browse them prior to the meeting. We've got 2 investments for you to review today, one in the real estate area and one in the New Mexico private equity portfolio. And Starla will update you on the recent ex-U.S. equity transition. And then Steve mentioned the draft ESG policy that we've been working on for a while. On the macro front, the economy here in the U.S. has been very strong as people are getting back to work, savings rates plummeting again, and people are spending strongly. Personal consumer expenditures look like they'll be up almost 13% when we finish the June quarter on an annualized basis. GDP estimates for the year of 2021, the 4 quarters of 2021, is now estimated at more than 8% real. We were around 5.5 to 6 there for several months, but the strength of the second quarter is pushing our macro guys to say more like 8% real for the 4 months. So that's great growth here for our country. We've gotten down to 1.5 to 2% on a real basis there for quite some time. So about 4 times that much for just this year. The Fed met last week, and they still don't expect to raise short-term interest rates until the second quarter of next year at the earliest, and with higher probability of it going into the third quarter of next year before they start taking rates up. And they expect to maintain the routine liquidity injections via Treasury bond purchases, at least here in the short term. So the Fed's still almost pedal to the metal still. So very, very supportive environment in the economy right now. Inflation is still running hot. Both CPI and PPI, producer price index, are rising strongly. Commodities are still high, and as Steve mentioned, there's discussions of possibly $100 oil, which is presently around 74, and that's up from 40. So just here in the last year. So big move in oil, which will definitely help our inflows. The financial markets, however, and they're ostensibly discounters of the future, are pausing. And I think perhaps wondering if growth, liquidity, and supportive interest rates are about as good as they're going to get. Stocks have been fairly flat since mid-April, and the benchmark 10-year Treasury note's been floating around 1.5% to 1.6%, kind of stalled out in that area. So very strong on the economy. I think financial markets may be sniffing it out that this is about as good as it gets, and trajectory from here is yet to be seen. But good numbers in the performance reports that RBK and our other consultants will be going over with you. I think you'll like the numbers that you see in there. So with that, happy to have any discussion around any of these points or anything else from a macro perspective, Madam Chair.
All right, thanks, Vince. Questions for Vince? So with that, we will move into a bunch of performance reports here. So we're going to start with April. I'll turn it over to Vince and RBK.
I've got no comments here, Marcia, if you all want to take it.
Matthias,
Okay.
you want to start us out with? Okay, sorry.
Yeah, perfect. And thanks, Vince, for those introductory comments. I think they're very helpful in terms of setting the stage for the numbers that you'll see. Today we have the April flash report, so it's just the summary abbreviated report, but hopefully gives you some sense in terms of what returns have looked like year to date and fiscal year to date. As we typically do, I'll make a couple additional comments on top of what Vince has already mentioned, hopefully, again, trying to frame some of the numbers that you'll see. And then Marcia is going to provide you the actual portfolio details. We'll start out on page 18 of the diligent materials, and you'll notice that we started including, even on a monthly basis, the capital markets overview page here. A lot of information. I'll try to point out a few things there, but hopefully you'll find that helpful as well as the commentary on the top left-hand side. We'll take a look at the bottom right, the market performance table, and you'll see that global markets in April, but really for the last year plus, have been doing very well, and in April continued as the pandemic is continuing to move forward, and we're also continuing to see relatively healthy first quarter earning numbers. So very strong returns really across all asset classes. In particular, public equities have continued to run, although we've seen that certainly run out of gas a little bit here more recently. And commodities, some comments there from Steve and Vince there as well in terms of some of the recovery that we've seen, as well as future price guide that has come out. So solid single-digit returns and really attractive trailing performance as well that I think you'll see flow through the portfolio returns as well. Even though April at this point feels a little bit dated, the S&P was up at one of the best months since November at that point, and again driven by a lot of the comments that Vince made, reopening of the economy, people starting to open up their wallets, and that has had a number of effects, including pricing pressures on top of the supply and demand imbalances that we've seen. Market leadership during that period did temporarily shift back to much of what we saw last year. So growth stocks, more of the tech stocks doing a bit better relative to value, and then large caps outpacing small caps. That has somewhat continued, although year to date, value and small cap are still leading the way. Through yesterday, the S&P 500 is up over 13%. So pretty strong numbers, although most of that was in the earlier part of the year. At the top right of this page, again, a lot of information, and apologize for the small print there. You'll see that we have the yield curve at various points in time. The two most recent data points are the blue line, which is March, and the green line, which is April. And there you'll notice just a modest downward shift at the longer end of the curve, and that in part supported fixed income returns. although treasuries and really most other interest rate sensitive sectors are still negative year to date through April. So fixed income, as you see down again at the bottom of that market performance table, down about 2.6 in April, year to date through April. And that has actually improved to negative 1.6, so clawed back about another percent in the weeks following April. Your diversified exposure and all the work that you've done in your fixed income portfolio, having both core and non-core, it's been helpful, additive. I'm sure Marsha will spend a couple of minutes on that as well as you look at those returns. Vince mentioned some of the inflationary pressures and drivers there. A lot of eyes on whether that is in fact transitory, as the buzzword is these days, or in fact more permanent. To be seen, but certainly a lot of eyes on that. I think the portfolio is well prepared for either scenario. You've been building up your real assets, and you'll hear more about that a little bit later today. So as a result, a lot of the inflation-sensitive assets have done fairly well in this environment, and we expect that to likely continue. So I'll stop there, see if there's any questions, comments that we can help address before passing it over to Marsha for the portfolio details.
Any questions from council? Marsha for the flash.
Thank you. First of all, I want to say that RGK will miss Carrie a great deal. Carrie's been fabulous to work with and very helpful, and wish you the very, very best. You will be sorely missed. Let's go to diligent, page 20, and look at performance. As Matthias said, this is April performance, so a little dated. Also a reminder that perform in the monthly flashes that aren't at quarter end, that the performance for private equity, real estate, and most of real return is assumed 0% for these intra-quarter months. So just keep that in mind when we're looking at the performance, and you'll hear end of calendar year performance from your specialty consultants today. But with that said, at the bottom of page diligent 20, you can see the performance that we're showing for the month of April. Land grant was up 2.24. Severance was up the same, 2.24. But I think if you go over to fiscal year to date, and again, this is through April, so 2 months left, your fiscal return to date was 22% for the land grant and over 19% for the severance tax. So incredible performance. Just a couple comments, and then we'll look at composites, and then we'll finish our report. But just a couple comments if you go to diligent page 21. Just a reminder, this is not reflecting the allocation changes that were approved in May. But just as a reminder, land grant and severance tax reduced the target allocation to real return by 2%. So the new target will be 10% to real return, and that balance was given to private equity. So in the land grant, private equity will go up to 13%, knowing that it will take a while to get that funded. It takes a while. And then on the severance tax, that target also goes, real return goes down 2%, and the target to private equity goes up. With severance tax, the target to the national program in private equity was 3%. That's going to move up to 5%, and then the state is about 9% of that allocation. Another change is on the next page of diligent, page 22, early childhood. The objective for that fund changed. So where the fund currently is shown to be all no equity exposure for early childhood, that was changed. The target allocation now will have 16% in equity split between domestic and non-U.S., and also some changes to the allocations for core, non-core, and there'll be some real return in that asset allocation going forward, as well as private equity. So just a little reminder there, you'll see that in the future. With that said, if you go to Diligent 24, the only place where we're showing a calendar year-to-date negative return, and that, again on Diligent 24, is with the early childhood. And just to remember, based on what Matthias was talking about with the environment for fixed income, there was no exposure in early childhood to equities. So therefore, you can see on a calendar year-to-date return, there was a negative return due to the rise in interest rates for a portion of that period. Going to Diligent page 25, this is looking at for the individual composites. And again, just a reminder that it's held at zero for private equity, real estate, real return. But looking at the more public composites, again, at the top, you can see the composites for the land grant and severance. Your global equity composite was up for the month over 4%. Go over to fiscal year to date, and your global equity combining, U.S. and non-U.S. was up over 37%, 37.35 on a fiscal year to date basis. Below that, you'll see the individual composites, U.S. equity up over 5% for the month, over 41 and a quarter on a fiscal year-to-date basis, and showing nice outperformance for that fiscal year period, also outperformance for the month. You'll recall that there was a transition in your U.S. equity portfolio, and it seems to be working. You've been outperforming your benchmark through the one-year period, and really strong, absolutely strong performance. Non-U.S. equity, on an absolute basis, a nice return for the month, over 2.9%, and fiscal year over 33%, trailing the benchmark somewhat, but you've gone through a transition in this portfolio. Starla's going to talk about that briefly a little bit later, but that portfolio has gone through a transition as well. Looking at your two fixed income composites, core fixed income and non-core fixed income, both positive for the month. If we look at a fiscal year-to-date basis, you can see non-core had a very strong return of over 13.5%, and core fixed income over a positive return where the benchmark was actually negative. So as Matthias was talking about the nice combination you have between core and non-core, just to make that point, I actually asked you to go over to the right, third column from the right, which is the year 2020. Last year in the environment where interest rates were going down, core fixed income was the leader there, doing nice, and you actually outperformed the benchmark. So your core fixed income returned 8.66 for the calendar year 2020. Non-core also positive, but did not do as well as core fixed income in that environment, but then switch to this year where the interest rate environment has changed, and you can see the combination of core and non-core, actually non-core for the calendar year, a positive return where core is negative. And again, that fiscal year-to-date return is on a comparative performance, nice for both, but non-core diversification, non-core has been very additive to the portfolio. Going to the next page, again, these are held at zero, with the exception of the financial real return toward the bottom. That is just a small piece of the portfolio, just under 1.5%. Just a reminder that is made up of mostly of MLPs and some short-term mezzanine debt, but positive return for the month and a nice return fiscal year to date of over 30%, almost 31%. So with that, RBK will take any questions on April performance.
Thank you, Marsha.
Thank you.
All right, if we don't hear anything from council members, we will move on. David, are you on the line?
I am. This is
All
David
right.
Lee, private equity.
Report? Yep.
Yep.
Okay.
This is is David Lee, Private Equity Director, and we'll be going through the performance reports for the National Private Equity Program and the New Mexico Private Equity Program right after that. We'll start with the National Program, and these materials start on page 44 of Diligent, but I think probably Richard Pugmire of Mercer will start on page 47. So go ahead, Richard.
Great, thank you, David. We're covering Q4 2020 performance today. As Vince mentioned, it does take longer to put together the Q4 performance because the funds receive an external annual audit. So it usually more than doubles the time funds have to send the reports. But the performance numbers we're talking about today are based on audited financials from the funds. And this first slide on page 47 is really meant to be an overview of performance and activity in the program. From an activity front, we've been very active the first part of this year. We're already close to the amount we committed to in 2020 with $305 million approved to 5 funds across 4 managers. From a performance perspective, Q4 was one of the strongest quarters the program's seen with a 12% quarterly return. And because of the size of the portfolio now, this equates to a gain of about $341 million. The table at the bottom splits the portfolio by vintage year, and these dates correspond to when the SIC launched a new private equity strategy for the national program in 2011. The challenge with private equity is it does take time for performance of the newer vintage years to have an impact on the overall portfolio returns, since the capital is drawn over time, and then it takes time for managers to add value to the portfolio companies. And so one of the things you'll see in this table is the 2011 and after funds have more influence on the overall returns with more recent time horizons, which makes sense since a lot of the value is realized in the older vintage years. But we still do not yet have 10 years of history with that 2011 and after funds. And you can see that since inception, it's still influenced by the 2009 and before vintage years since there's more history with those funds. One thing to highlight is the strength of the performance over the last year with an overall net IRR of 21%, which is led by the most recent funds. That includes a Q1 that, if you'll recall, in that 1-year number that was negatively impacted by COVID and had a large loss of over $200 million. So it really shows how strong the last 3 quarters have been for the private equity program. Overall performance is at a net IRR of 12%. Since inception for the 2011 and after is at 16%. And for the 2009 and before, which has more history, is at a 10.5% net IRR. If you turn the page to page 48, this has a summary of the numbers in the portfolio. Overall, the net asset value increased by $254 million, driven by that sizable quarterly valuation gain that I talked about. Year over year, this table shows the impact on both net multiple and net IRR has been positive from those 3 strong performing quarters, with the overall multiple increasing to 1.5x from a 1.44, and the since inception net IRR increasing to 12% from 11.5. Looking at the strategies, buyout and growth continue to be the strong performers, with both strategies at a 13% net IRR. In the industry, venture capital has actually had a really strong year overall, but the national program doesn't really have any sizable exposure to venture capital. If you'll recall, we made the first new commitment about a year ago, and so it has not participated in that increase in venture capital that we've seen in the industry. The next page has the quarter-over-quarter performance. This really shows the strong performance over the last 2 quarters. We started this trend of gains in quarter 2 with a $195 million gain, which then increased to $228 million in Q3, and then $341 million in Q4. And remember that there was an over $200 million loss in Q1. So it's been a volatile year as far as performance goes. All strategies contributed to the quarterly gain, and we also saw contributions continue to be strong with about $106 million called from the funds. But Q4, different from the prior quarters, was particularly strong for distributions at $194 million coming in. We had a lot of deals that had been delayed due to COVID come to a closure in Q4. And then looking at the cash flow subsequent to Q4, we continue to see distributions strong with $295 million received through the end of May compared to $156 million of contributions. from my perspective, when you have these type of performance increases, you want to see realizations because the unrealized gains can be marked down like we saw in Q1. So it's nice seeing the value come back into the portfolio in the form of distributions. The next page goes into more detail about the drivers of contribution distributions and the gain and loss. On the distributions, we have seen a lot of sizable distributions driven by technology investments in particular. And in the upper right corner, you can see the gains by fund, the top 5 gains there. And many of the gains were driven by technology companies, which continued the trend that we were seeing in prior quarters. But we're also now seeing a recovery in companies that may have had lower valuations or performance impacts from COVID. There's 2 funds on there that are more consumer retail focused and don't have as much technology exposure. So it's nice to see that recovery coming through. Another driver of the overall quarterly gain is just the lack of sizable losses in the portfolio during the quarter, which you can see in the table in the lower right. The next page compares performance by vintage year against the Burgess Private Markets benchmark. In recent years, the 2011 and after, net multiple is above median in all years except 2013. 2013 is dragged down by a fund that did a considerable amount in energy, which actually is a positive performer. So it's not at a loss. It is in the 4th quartile because overall private markets returns have been strong for that vintage year. If you do look at the remaining value on the left, 2014 and 16 have the largest numbers with over 1.2 billion of remaining value. There is particularly strong performance in the 2014 and 2016 years. 2014, we've actually had a fund in that vintage year that's seen a strong recovery in performance due to companies that have actually benefited from COVID trends. And 2016, which is the strongest vintage year on this page, was driven by 4 managers who have IRRs greater than 20%. The next page has the public market equivalent performance, where we calculate an internal rate of return using the cash flows from the portfolio and the index values. Public equity markets have also had a strong run, and the national program is underperforming the Russell 3000, which has been driven by large cap tech recently. However, the national program is slightly above the Russell 2000, which focuses more on the smaller companies. And then the MSCI ACWI benchmark, which covers multiple countries and geographies, including the US, Europe, and Asia, the national program is outperforming by 4.9%. We like this benchmark for the national program because the national program also has a global focus. And then first, I'll conclude on this slide for the national program with just a summary of the strategy and the current state that we're in. We have a 300 million to 400 million annual pace. We hit that range in 2020 with 330 million closed. We're already within that target through the end of May with 305 million approved. The sub-strategies and geography exposure are all within target. You'll notice Asia and emerging markets is at the lower end of the range, but we expect that will increase as capital is drawn from KKR Asia, which was approved last year. We still have one general partner that's above 10%, but with recent commitment activity and some realizations from that manager, it's now down to 11%, so it's almost in compliance. Overall performance for that manager too is at a 14% net IRR, so it's been additive to the portfolio overall. And then on the fund series, there are 5 fund series currently above 5%, but the lowest performance of the 5 is at an 18% net IRR. So a lot of that has been driven by positive performance. As far as managers go, we have been disciplined with new managers over the last 9 years. 29 managers have received new commitments. There's still a lot of older funds in the portfolio that we continue to manage. And if you take out those 2007 or older funds, we'd be at 65 managers. So with that, I'll conclude my remarks, and I'm happy to answer any questions anybody might have.
All right, so that's the Q4 report on private equity. Any questions?
Madam Chair, this is John Bingaman.
Yes. Yes, Member Bingaman.
Just sort of a suggestion or a question, depending how you look at it. But I think on page 47 of diligence, pretty interesting, just how different the returns are, 2009 and before versus 2011 and after, when our current team effectively came in and the council was restructured and sort of the new program was put in place. I mean, at what point is it appropriate to stop, looking at the since inception numbers and just focus more on, the last decade or so that's more reflective of the program today?
David, Richard?
Yeah, I'll give my answer. I mean, what we try to do in this performance report is just give a complete view, both what's going on recently and also the historic performance in the report. But one of the reasons we started doing this table was we felt like that focus on since inception was no longer should be a big focus. I mean, it's interesting to have that number to see what the benefits private equity has brought to the State Investment Council since its inception. But really, the recent performance is what's going to drive the future performance from here on out.
Yeah, this is David. I think it's a very good comment by Member Bingaman. I think in private equity, we are used to thinking about everything, funds with different vintage years from a since inception return, due to the fact that these returns are fairly lumpy. Some of them happen, a lot of the values added between years 4 and 7 for most funds, but some of them, believe it or not, have stronger performance at the end, and some of them get off to a fast start. So we are used to looking at everything from a since inception number, but for the purposes of performance and performance for the council, I think what is actually more relevant to Member Bingaman's comment are the more recent time periods, the 5-year, the 10-year. You want to know how your performance is doing for that period, and there's probably no other asset classes where you're looking at longer than that, and things like RVK's report reflect that. So definitely a good point.
Any other questions before we move on to the New Mexico program? All right, folks, I'm going to have to hop off the meeting. I'm wondering, Member Lavender, are you available to chair?
Sure, I'll be happy to do that, Madam Vice Chair.
Sounds good. And I actually think that we had, the treasurer was on, but he just texted me to say that the phone he was using, we couldn't hear him. So I do believe he is on.
Great. Okay. Well, let's move.
Can you hear me now?
I'm sorry?
Harold, can you hear me?
Yes, sir, I can. I can hear you now.
Okay, great. Well, I've just been switching phones until I could get in, so I'm glad that you can hear. And I'm sorry to interrupt you, but I've enjoyed.
No problem. We got a lot of good stuff to cover here, so we'll just keep moving. Let's move on to David, to the performance report of the New Mexico private equity program. David?
Thank you, Mr. Chair. I'll turn it over to Mercer again to talk about the New Mexico program performance for the fourth quarter. Go ahead.
Thanks, David. And I'm on page 75, which is a performance overview for the New Mexico program. And similar to the national program, we'll start with the slide that shows the time horizon performance by the category of funds in the New Mexico program to give you a better sense of what's driving performance over different time horizons. We also split the fund investments here by 2008 and before and 2016 and after. If you'll recall, there was a requirement in the program for managers to open an office in New Mexico and staff it with a senior person. And that requirement was removed, and it opened up the possibility of adding more high-quality managers to the program, which was the focus beginning in 2016 and drove the reason for splitting the fund investments in the portfolio. And the table really shows the impact of that decision so far, as fund investments have generated strong performance, even though it is still relatively early. Since inception, these funds are at an almost 19% net IRR and a $23 million gain. However, the newer funds do not have as much influence on the overall return because the relative size is smaller and they have less history. So from a return perspective, the co-investment funds still have a large influence on both near-term and since inception performance due to their longer history and larger size, and could continue to have an influence since they are largely unrealized. And you can see over the last year, the co-investment funds are down 10%, which has been a driver of the overall one-year return being down 4.7%. From a commitment activity perspective, we've done one commitment so far in the New Mexico program this year for $5 million, and we're proposing our second commitment later today. On page 76, we have the overall summary of numbers again by category. And overall, the net asset value increased by $32 million. And it was driven mostly by capital calls. And we also had some portfolio gains in the quarter. There's been a slight decrease in the since inception numbers, really driven by the co-investment funds. They had a large holding go public, which caused a valuation decline, and it's caused some volatility because that stock has kind of moved up and down. And there's also another company realized at a lower valuation than it was valued at a year ago, which created a drag on performance for the co-investment funds. Note that the 10-year return is better than the since inception return at 3.4%, which shows the improvements in the program over the last decade, but it still declined from 5.6% at year-end 2019 due to the co-investment performance. Page 77. This goes into more detail on the quarter-over-quarter performance. You can see that the $36 million of contributions and the $6 million gain that led to the net asset value increase. The contributions have really been driven by the recovery fund drawing capital, which was about $29 million in the fourth quarter. The gains are driven by write-ups in a couple of funds that we'll show on the next slide. Post Q4, we have seen contributions continue with $32 million called, mainly driven by the recovery funds again, and then also $6 million of distributions that we received from both co-investment funds and fund commitments. The next page, page 78, has more detail. You can see in the upper left the top quarterly contributions with the New Mexico Recovery Fund at the top. We had several gains across different fund investments, mainly driven by companies raising capital at higher valuations. And the gains more than offset the losses that we saw in the quarter as well. The next slide has benchmarking, page 79. This slide shows how the performance by vintage year compares against the benchmark. But as a reminder, this is a differential return program. So we're not necessarily looking to outperform, but we do want to see a positive return. And we do see a positive return in 10 of the 16 vintage years that we show here. This slide also shows the strength of the venture capital benchmarks, which is influencing the quartile rankings, because if you look in 2014, 2016, and 2017, the median cutoffs are all above 17%. And even though 2016 and 2017 vintage years have been pretty strong for the program overall with a 15% and 12% net IRR, it's below median compared to the benchmarks just because the overall industry performance has been so strong in the venture capital industry. The next slide shows the public market equivalent, just like we do with the national program. There is underperformance, not surprising, across the three benchmarks that we do the public market equivalent calculation to. And then slide 10, or page 81, shows the economic impact from the New Mexico program. We gather this data from the managers every quarter to give a sense of what kind of New Mexico activity is going on in the underlying investments. The Recovery Fund has increased the number of New Mexico companies in the program to 99, with 22 companies receiving investments in the last 12 months. The total invested from the State Investment Council is up to $322 million. And at the fund level, it's at $424 million. So that includes additional capital coming from other limited partners in these funds that went into New Mexico companies. Looking at the last year, there's been $54 million invested. The recovery fund is a large driver of that, but we have had some funds that have also made New Mexico investments over the last year. The next slide shows additional economic impact numbers. Jobs at the companies are reported as 2,151, and most of those jobs are in active companies that are still in the portfolios. The job growth increased by 557 since the New Mexico program's investment inception in these companies. So this is another measure of growth we do on jobs, where how many jobs have these underlying companies created from the New Mexico program's first investment to now, or when the company was exited. The annualized New Mexico payroll is at $120 million, and expenditures on New Mexico goods and services is reported at $72 million. And the next slides go into more detail on different aspects of the program and diversification, but I think we could open it up to questions at this time.
Are there any questions about the New Mexico program? Hearing none, let's move to 2F. Paul Chapman.
Thank you, Chairman Lavender. Paul Chapman, Director of Real Estate and Real Return. And the first matter we have on the agenda is the Real Estate and Real Return Performance Reports for Q4 2021. The Real Estate PMR starts on Diligent 98, and Andrew Bradley from Townsend will be handling the PMR presentation for Townsend with color commentary from Seth. And before turning it to Seth, though, I do want to point out returns for the fourth quarter, as you already heard a couple times this morning, are always delayed due to extended reporting times granted so as to accommodate fund audits. You'll see that we had a strong fourth quarter, which put us back slightly above our benchmark for the year, and not to steal next quarter's thunder, but we have the returns in for Q1 2021, and our outperformance continues to the tune of about 100 basis points. So in all, looking back at our early fears about the impact of the global pandemic on economies, and particularly on our areas, real estate, I think that a one-year positive return of 0.4%, which includes the legacy portfolio, is a big relief. And most of our managers are expecting fairly strong returns as we continue through 2021. So with that, I will turn it to Andrew and Seth to take you through the Townsend PMR.
Thanks, Paul, and good morning, everyone. This is Seth Marcus from the Townsend Group. And I'll just briefly mention, so Andrew Bradley's going to talk about the performance report. He's been working with the New Mexico staff and Townsend, on your account for about 2 years now. And as everyone's reiterated, this is the year-end 2020 performance. With the extra time delay, we also include a full page summary of each and every investment in the back of our sort of an appendix section of our report. So these are highlighted in your annual report for both real estate and real return. The 4Q performance was considerably strong at over 3% for the quarter. The last time we saw a quarterly return at that level was 2017. So we're seeing this bounce back after the depths of sort of the COVID environment in our first and second quarter of the year to a positive 3%, which drove our longer term performance. But I'll hand it over to Andrew now and let him sort of present the performance for real estate.
Thanks, Seth. Thanks, Paul. Good morning, everyone. As Seth and Paul both kindly introduced me, my name is Andrew Bradley. Given the rather full remaining agenda we have, and the fact that you'll be hearing from us more following these reports in the investment section, I plan on going through the performance in a pretty timely manner. So as always, we'll start with the real estate portfolio. I'll begin by referencing materials on slide 101 of the diligent booklet, or slide 4 of our Townsend presentation. I'll just give you a quick moment to get there before I start. So after a rough first half of 2020, like the broader market, we experienced a bit of a bounce back in the third quarter, which only accelerated further into the fourth quarter. Our real estate investments generated a positive 3% net return for the quarter, outperforming the NFI Odyssey Index by 190 pips. As you can see on the chart shown at the bottom of slide 101, and as Paul stated in his opening comments, we are now back to outperforming the benchmark over all time periods, whether you are looking at the total portfolio return or strictly the 2011 inception rebalanced portfolio. Though the market as a whole continued its recoveries from lows in the first half of the year, it is worth reflecting on why our real estate portfolio continues to rebound to a greater degree than many of our peers and our benchmark. We believe this outperformance can be tied back to the time poured in over the past few years by members of the CIC, SIC, and real estate staff, approving and recommending investments with strong institutional partners, all while pursuing an overweight to industrial, which has seen significant demand increase driven by e-commerce, and an underweight to both the office and retail sectors, both of which have some remaining uncertainty surrounding both their near and long-term futures. Additionally, we anticipate an overweight to multifamily in the near future as capital is called from previously approved investments. And multifamily continues to be viewed favorably as it's one of the more resilient sectors. One more thing I would like to highlight. As of fourth quarter 2020, the real estate allocation stood at 9.7% versus our 12% target. This represented a 60 basis points decrease in allocation quarter over quarter due to a significant increase in total plan assets. This increase in TPA, yet again, was driven by the continued rebound of equities and the broader capital markets. It is important to note that though the allocation as a percentage of TPA decreased, the value of our real estate portfolio did increase quarter over quarter by $106 million, driven by strong income and appreciation returns. Now, moving on to slide 102 of materials, I'd like to focus once again on something we touch on each and every quarter. The graphics on the bottom of the slide show income and appreciation of our real estate portfolios versus the Odyssey benchmark. On the left-hand side, you'll see income and appreciation breakouts for both the real estate portfolio and Odyssey on an annual basis. When you look at this graph, you'll notice how high-quality income generation has been resilient even through the toughest of times. And you'll also notice that if you look back over the past 7+ years, we've outperformed year in and year out. Now, if you move your eyes to the chart on the right-hand side, you'll see the annualized since inception total return of the New Mexico real estate portfolio closely tracks the Odyssey index total return. Though the real estate portfolio delivered lower income returns due to no core exposure from 2005 to 2011, the appreciation return generated by the real estate portfolio significantly exceeded that of Odyssey over the same period. When looking at the rebalanced portfolio since inception, or 2011 inception, which can be found on the right half of that graph, you will find our income return now closely tracks with Odyssey while our appreciation returns continue to significantly outperform.
Andrew, I'm going to interrupt you just to go on the next slide real quickly. And we make this comment on slide 103, page 6 of our report. And it's focused on investment pacing. As you know, we seek to maintain vintage year diversification. We've done so, as you can see in this chart, since 2011. There was a gap there between 2008 and 2010 where no commitments were made as the portfolio was being rebalanced and changes were being made at the council level. But since that time, we've made consistent commitments both in the core, primarily in the non-core space, but also in the core sector. On an annual basis, our model calls for approximately $300 million of annual commitments. We will be over that this year, close to over $400 million in 2021. This is not something that causes any heartburn. It will not cause any portfolio compliance issues. I just wanted to highlight that the overweighting these vintages is really a result of the investment opportunities presented to us today in the current market environment, and most likely will be affect underweighting in future years, future commitments going forward. But I just want to cover that quickly, and I'll hand it back to you, Andrew. Go ahead.
Thanks, Seth. Yeah, that's good to know. That's a good point. Next, we will hop over to slide 104 of diligent material. On this slide, we highlight the fee savings we're able to achieve on an annual basis. And you will see as of fourth quarter, this number stood at $2.3 million annually, year in and year out, from 8 different managers for 13 individual funds. These fee savings are a result of the SIC partnership with Townsend, whereas Townsend is able to negotiate fee savings for our clients due to aggregating client commitments and negotiating fee savings for all clients based on this weight of capital. Importantly, these savings are 100% to SIC. Townsend in no way benefits from these fee savings. And most importantly, the portfolio is consistently outperformed by investing with strong institutional quality managers, while at the same time reducing the portfolio's overall fee load. Now, if you wouldn't mind skipping to slide 109 of materials. On this side, you will find a 1-year return attribution. I like to highlight this slide as I think an attribution does its best to convey what risk types have contributed positively to the 1-year net return and which risk types have subtracted from it. I personally find this chart provides a good high-level summary of what has occurred in the real estate portfolio over the past 4 quarters. So in the chart, you will see that the core portfolio has had the largest positive impact on the portfolio in the short term. This is due to its sheer size. It's currently 66% of the current portfolio, and then combined with its strong and steady returns. The value add portfolio was the only detractor for the year, as its overall performance was driven down by the limited exposure to retail specific funds in the portfolio. As we've mentioned in prior reviews, retail was heavily stressed during the global pandemic. And while we are underweight retail compared to the benchmark, we still have exposure, and a large portion of that exposure is located in the value add portfolio. Furthermore, looking at the chart, the opportunistic investments had a positive impact on the overall real estate portfolio, while credit, due to its small size, had a minimal impact. Lastly, before I wrap things up for the real estate portfolio, I think it is important to touch on the next slide in the deck, slide 110. This slide shows the PME, or public market equivalent analysis. Given the volatility in public markets that we have experienced in 2020 alone, it feels important to showcase this graphic. As you can see on the graph, despite volatility in the public market, significant rebound in the back half of 2020, the real estate portfolio since inception has closely tracked, while the new portfolio since 2011 inception has significantly outperformed their respective public market equivalents. I guess I'll stop here and happy to answer any questions you may all have.
Are there any questions? Okay, Paul, continue.
Yeah, thank you, Chairman Lavender. And again, we're going to just turn it over to Seth and Andrew here. The diligent report starts on 186, and it's already been mentioned here that we've reduced our target allocation from 12% to 10% effective June 1. 2020 was a disappointing year, but Q4 returns, which Andrew and Seth will talk about, helped us recover lost ground. And we had a strong Q1 2021 as well, led by a recovery in the energy aspects of our portfolio, specifically the AMLP portfolio and our conventional energy assets, which have been marked up fairly dramatically in Q1, and even this far into the second quarter, we know that AMLP is up another 20%. So is the benchmark we use for our harvest book. So things are looking more promising in that real return portfolio. And with that, I'll turn it to Andrew.
Thanks, Paul. I'll begin with materials located on slide 190, diligent book. Townsend slide 5, for those of you following that. I plan on getting into overall performance and drivers of such performance, but before diving straight in, I do think it's important to note a significant differentiating factor between the real return portfolio and real asset portfolio. as returns vary greatly between the two, which can be seen displayed on the chart below. It's close to a 200 bps difference for the quarter. So our MLP position is included in the real return portfolio, but not in the real assets performance. And that's an important distinction to keep in mind as we work our way through this portfolio review. As you may recall, and as Paul sort of touched on quickly in his notes, since the onset of the global pandemic, we have talked at length about the MLP performance. And just to recap and highlight the volatility we have experienced, in the first quarter 2020, the MLP portfolio our position generated a negative 49% return. Second quarter generated a positive 33% return. Third quarter produced a negative 9% return. And now in the fourth quarter, rebounded yet again and delivered a positive 23% return. All in all, bringing the MLP performance in 2020 to a negative 25% return, which is really a main driver of underperformance for the real return portfolio over all time periods, except for this most current quarter, fourth quarter. Now to move on, as you can see on the chart, and as Paul quickly mentioned in his intro comments, the real return portfolio rebounded nicely to end the year. Performance was significantly positive for the quarter, producing a positive 5.9%, driven in part by that 23% quarterly MLP return. If you turn your eyes to the second bar on this chart, the lighter blue, this is the real assets performance, which essentially strips out those MLP returns, and as you know, includes infrastructure, energy, timber, and agriculture. While these investments perform well over the quarter, delivering a positive 3.9% net return, and continue to perform well over the longer term, they too have struggled and underperformed the CPI plus 300 bips benchmark over the 1 and 3 year time period. I'll talk about this short-term underperformance in more detail shortly, just a little bit later in the performance review. Given Townsend primarily focuses on NMSIC real assets portfolio and specifically infrastructure, timber, and agriculture, with energy covered by your staff and other consultants. Outside of these first two slides, we show metrics based only on the real assets portfolio. So that's important to keep in mind going forward. As stated in the summary on slide 192 of diligent material, our allocation in the fourth quarter of 2020 was 7.1% versus a target of 9.6%. It is important to highlight that seller allocation as a percentage of total plan assets declined by 20 bps quarter over quarter. The real assets portfolio value increased $112 million over the same time period. To give a bit more context on the situation, this is attributed to the denominator effect. It's where CPA increased to a greater degree than the value of real assets. It's much like what we saw occur in the real estate portfolio as well. The increase in portfolio value over the quarter was driven by over $55 million in capital contributions for new investments, as well as over $87 million in asset appreciation and income. This was partially offset by $41 million in distributions and fees. Additionally, during the quarter, NMSIC officially closed on one previously approved infrastructure investment, specifically the Brookfield 5 renewable sidecar for $75 million, and approved an additional $100 million infrastructure commitment to Macquarie Infrastructure Partners 5, which officially closed in February 2021. As most of you know, the infrastructure sector has been a main driver of performance for the real asset portfolio and will continue to be a focus going forward. Next, I would like to highlight both the performance charts on slide 194 and 195 of diligent materials, slide 9 and 10 of Townsend materials. Starting specifically with the real assets net return graph, which can be found on slide 194. As stated earlier, the real assets portfolio performed well for the quarter and has continued to perform well over the 5-year period, but is delivering underperformance in the short term, specifically that 1 and 3 year time period. This underperformance can be attributed to the agriculture and energy portfolios, both of which I'll go a bit more in detail on the next slide. important to note that the portfolio is measured against the CPI plus 300 bps index, which has been and is currently being evaluated by NMSIC staff and consultants. Given the lack of true valuation change in the CPI compared to our real asset portfolio. Now moving on to slide 195. If you take a look at this slide, you'll find a 3-year net return attribution chart showing primary drivers and detractors of overall portfolio performance. Similar to what was seen in real estate, except for instead of a 1-year time period, it's a 3-year time period. Consistent with previous reports, infrastructure remains the primary driver of performance, again, due to its size and strong, consistent performance. Timber and the other category also positively contribute to performance. If you take a glance at the graphic, you'll notice 2 red bars. Those 2 red bars are agriculture and energy. Those were the 2 sectors that detracted from portfolio's performance over the time period. And to go a bit more in depth, explain this underperformance. The energy market remains volatile and delivered a negative 4% return for the 3-year time period. It's worth noting that the 3-year return is heavily driven by performance in 2020, which sounds obvious, but applies this scenario exceptionally well, as the energy portfolio has produced outperforming returns over both the longer term and the quarter, but suffered a negative 18% 2020 return, resulting from both the pandemic and a short-term spike in energy pricing. This further resulting in a drag on long-term performance, especially that 3-year time period. Agriculture did not perform any better as the portfolio delivered a 3-year net return of negative 6%. But to provide a bit of context on this underperformance, agriculture has been impacted greatly by currency exposure in South America, primarily Brazil, where in 2020 alone, the currency devalued by over 20%. And I'll reiterate an interesting factor or note mentioned in the previous quarters. For those of you that follow currencies in the global economy, the Brazilian real, which we have a little bit of exposure to, has appreciated every year since 2011. Another factor of underperformance is that agriculture vehicles take an exceptionally long time to generate returns. And that's just part of their nature. It's a very long-term asset class. That all being said, the global pandemic and its impact on global demand and the supply chain has not really aided the agriculture sector in any way. In the interest of time, I'm going to stop here. Happy to answer any questions.
Are there any questions about this part of the report? I think that, diversification is the key, and I think that these reports today are pretty positive. And despite the fact that real return is lagging, I think that it's critical to keep this kind of diversification in the portfolio. Paul, do you have anything further?
No, I think that's absolutely right. I mean, we've been frustrated with our timber and ag returns for some of the factors that Andrew pointed out. But, I think they're part of having a diversified portfolio. It will dictate a little bit how we allocate capital going forward because, we've had pretty reliable performance from our infrastructure assets investments. So, that'll draw more capital than the other sectors.
Great. I think we'll obviously keep our eyes on this. And if there becomes a point where we need to reanalyze these kinds of investments, the real things, we can do that. But anyway, that's terrific. I think that we pay attention to this very closely at the investment committee, and we're going to continue to do so. If there are no questions about this particular part, we can move into section 3, investment matters. What we'll do is, I think the investment committee report my investment committee report will be real simple. We covered everything that we've covered up above at that meeting, and we've got these 2 investments to talk about today, plus the ESG draft report. What I'd like to do is to turn this right back over to Paul to talk to us about the real estate and the AXA Life Sciences Fund. I think, Paul, you need to explain to the council again, why this was different this time because of the nature of I'll let you explain it. But we vetted this very closely at the investment committee and unanimously recommended approval in spite of some of the challenges that we faced at the time of the investment committee meeting. Those challenges have been managed, and I'll let Paul tell you about it. Paul?
Thank you, Chairman Lavender. And yes, I do intend to cover the kind of strange process that we've gone through here. I just want to note that I'm joined by Clay Camper and Nino Carpenito from staff, and of course, Jack Koch, Seth Marcus, and Andrew Bradley from Townsend. After Townsend's comments, I'll be turning the presentation over to the AXA team, which consists of Isabel Samama, who's the global head of AXA Investment Management Alternatives, John O'Driscoll, who's the European head of transactions for real assets, and we also have Stefan Ackerman, who's the head of their client group. Staff is requesting approval of a commitment of up to €50 million to AXA European Life Science Strategy, the fund, or ELSS, as we may call it here, for the New Mexico State Investment Council's real estate portfolio. As Chairman Lavender mentioned that I should do, I want to start off by mentioning, due to time constraints imposed by the general partner, we've not been able to follow the customary CIC and SIC review process. At the CIC, instead of the usual Townsend written cover memo and a full Townsend in detail report, staff provided a staff written cover memo along with a slide deck provided by the general partner. CIC approval was conditioned on receipt of the Townsend in detail report. Similarly, we normally provide the SIC with a Townsend written cover memo and a full in detail report along with a slide deck provided by the general partner. However, in this case, the SIC members have been provided with a staff written cover memo, a draft Townsend in detail report, which you didn't receive until last evening in your email, and a GP presentation. So why are we not following the usual protocols? Well, there's two reasons for that. First, the GP has set a very aggressive timeline for lining up and closing LP commitments, and Townsend didn't have time to complete their underwriting in a way that's synchronized with our CIC and SIC meeting dates. Secondly, both staff and Townsend have strong conviction around investing in the life sciences space. So we thought it was worthwhile to work through an expedited process to participate in this fund. And when I say an expedited process, I want to assure the SIC members that there were no shortcuts taken in either staff or Townsend's due diligence, just that the timeframes were greatly compressed. As outlined in the staff cover memo, AXA Investment Managers is raising a €750 million fund for a 40% stake in ELSS, with AXA Group investors retaining the remaining approximately 60%. ELSS will be a closed-end vehicle focused on the expansion of Cadence Science Partner, a leading developer, owner, and operator of life science parks and campuses within Europe. Cadence has an existing portfolio of 24 operating life science assets, most of those are in the Netherlands, and 8 development stage assets across 3 countries. Approximately 30% of the commitment that we're making will be utilized to fund the existing portfolio and the secured pipeline. The fund will be a value-added investment strategy targeting net returns of 10 to 12% with portfolio leverage of 50% or less. ELSS will be focused on expanding Cadence life science platform across Europe with a develop-to-hold strategy and geographical emphasis in the Netherlands, the UK, Germany, Spain, Belgium, the Nordics, and Switzerland. The existing portfolio includes assets in the Netherlands, UK, and Germany. The current assets are a mixture of stabilized and development assets with future pipeline expected to be roughly evenly split between development, renovation, and stabilized properties. Since we have both Townsend and AXA on the line, I'm not going to spend time describing the fund's investment strategy, but I would note that in November of 2020, the SIC approved a $50 million commitment to Blackstone Biomed Life Science real estate, which consists of a portfolio of life science properties, about 95% of which are located in the U.S. Though early days, that fund is performing very well, and we believe that the AXA European Life Science strategy is a nice complement to that prior commitment. There's a lot of factors which make life sciences an attractive real estate investment, and those factors transcend investments related to the COVID-19 pandemic, although most believe that research on COVID treatments, therapeutics, and vaccines will continue for years to come. Most importantly, we consider the life sciences sector to be driven by secular tailwinds and demographic drivers. The aging baby boom population is driving higher per capita spending on healthcare, including pharma spend, while advances in biology, gene therapy, cell therapy, immunotherapy, chemistry, and tech are speeding the development of drugs and therapeutics. If approved, this will be New Mexico State Investment Council's first commitment to AXA. Although less known in the U.S., AXA Investment Management is one of the largest real estate managers worldwide, with 93 billion euro of public and private real estate under management, 77 billion of which is in direct real estate investments. The firm has a global presence with 10 of their 14 offices located within Europe. The parent company, AXA Insurance, is the third largest insurer in the world with a $55 billion market cap. ELSS will be focused on expanding Caden's life science platform across Europe with a develop-to-hold strategy and a geographic emphasis, as noted before, in the Netherlands, the UK, Germany, Spain, Belgium, the Nordics, and Switzerland. Staff has determined that an investment in the fund of 50 million euro is consistent with the real estate investment policy constraints and objectives as set forth in further detail in this paper. Subsequent to an investment in this fund, the real estate portfolio will remain in compliance with all policy statement requirements relating to portfolio construction, including sector allocation guidelines, manager diversification limits, international exposure boundaries, and leverage. Now, there's a lot more to say about the life sciences space in general, about the amount of capital that is flooding in, both to Europe and the U.S., to how this is highly differentiated from other types of conventional office. We could spend an entire day doing a seminar in the life sciences space. I promise you I won't do that. But it's a very complicated space, and we think this is really an excellent platform for us to invest in a sector that we just think has a lot of strong tailwinds. So with that, I'm going to turn it over to Townsend, and then we'll go over to the AXA group.
Thanks, Paul. This is Seth Marcus again with Townsend. So as described, we're here to discuss the life science investment, as Paul sort of highlighted. To provide maybe a bit more context around the underwriting, the approval, the due diligence, just yesterday, Townsend's investment committee formally approved the fund as a buy-rated fund for New Mexico SIC, as well as approved our 50 million euro commitment that we're discussing here today. So for that reason, you now have our in-detail report that was sent out via email last night. To echo Paul's comments, after discussing the opportunity internally at Townsend and also with your staff, we view this as a compelling and also a unique opportunity to partner really with a life science investment strategy that fits our view of the world. As Paul mentioned, given the due diligence and closing timeline, Townsend's underwriting was only recently approved, and there's a couple of odds and ends within that report that have to be just kind of finished up, which is why you see it stamped draft. But ultimately, that is an approved and document that was sent out yesterday. It's important to highlight that AXA represents that they are well over 2 times oversubscribed for this fund and is actively discussing allocation and cutbacks with all potential investors. So for that reason, we just wanted to highlight and make everyone aware there's a chance we do not receive our full 50 million euro commitment if it's ultimately approved today. Quickly, from a portfolio construction standpoint, this would represent our 6th non-core commitment for 2021, with 425 million of commitments already approved and or closed. As I mentioned in the real estate report, the pacing model calls for approximately 300 million, so we are over allocating to this vintage, but this is not anticipated to cause any portfolio compliance issues or over allocation, as we are still striving to really achieve that 12% target allocation within real estate. And what this may impact is the amount of future annual commitments we make when we rerun our pacing model next year. Before getting into the report, or maybe part of the report, I did want to highlight Townsend's favorable view on the life science sector. So the healthcare themed investment opportunities, it really has existed for a number of years, and it's now sort of accelerated in front of mind due to the COVID pandemic. As Paul mentioned, we made a Core Plus U.S. life science commitment with Blackstone earlier in the year under the same premise of why we like this opportunity in Europe. So life science office is highly specialized space used by medical and tech companies to conduct research and development. And to that point, global pharma R&D spending has grown by over 7% per annum over the last 20 years. Europe's population is aging much like that in the U.S., and there's been a 20% increase in healthcare expenditures over the 5-year time period between 2012 and 2017. Was there a question there? Sorry. Okay, maybe not. So in several European countries, this equates to approximately 10% of the EU GDP dedicated to healthcare. Now, all these stats are pre-COVID, so it's accelerated obviously since then. Life science tenants tend to be stickier than traditional office tenants due to high capital expenditures on the front end, really paid for by the tenants. So as a result, you have higher retention rates. Capital expenditures as a percentage of net operating income for life science office, and that's after the initial build-out, is typically lower than office, considerably lower, about 19% versus 37% for traditional office. So the buildings typically come with higher load capacity, higher ceiling heights, additional HVAC and ventilation systems and power requirements. So the additional building requirements has historically limited new supply and created a positive supply-demand dynamics for investment. Excuse me. Strong performance by the life science sector has attracted more supply going forward. We are seeing that. However, this supply is well below the demand forecasts we see. So in short, while life science is technically office exposure, we've been talking quarter after quarter about our underallocation to office, and it's benefited the portfolio. However, we like this life science office subtype within the office category. Specific to the AXA European Life Science Venture, the fund here, as Paul mentioned, will seek to develop and operate life science assets in Europe, largely managed by the Cadence Science Partner in Europe, life science and real estate specialist, which was recently purchased by AXA. When we consider the strategy of the fund, we view this as a build-to-core and acquire-to-core strategy. So the fund aims to hold a portfolio of assets whose occupiers have a primary focus on science, technology, and knowledge-intensive activities. The fund will target assets in existing and emerging European life science clusters. And when the fund is mature, investments will be largely stabilized assets, with up to 30% being assets requiring either repositioning, refurbishment, and new development. The strategy and the execution and asset management will be led by the Cadence team, while AXA provides fund management and enhanced deal sourcing capabilities. In addition to the life science sector, which I highlighted already, there's other advantages we highlighted in our memo include the specialist life science partner that we've continued to mention. So we've talked about past investment approvals and the benefit of investing in both capital allocators and operators. So allocators tend to have a more diversified strategy and then allocate capital to on-the-ground operators who then manage the investments. And then we've also invested with operators who are the local operating partners. We've done this more so in industrial and multifamily. And here we have a local operating partner in Cadence that is operated and owned by AXA. So in a specialty property type like life science, we like to see the local operator as a strong benefit over alternatives in this sector. This investment also comes with a pre-specified portfolio, both of existing assets and development opportunities. Given the valuation gains experienced in the sector, we believe this portfolio presents some embedded value to investors coming into the fund. As with any investment, we also highlight a few potential issues and concerns in our report. We believe each of these is well mitigated, but still worth noting. In the interest of time, I'll only go through one of these in more depth and before handing it over to the AXA team. So as mentioned, the fund strategy includes development, repositioning, as well as asset acquisitions. So while the fund starts with some pre-specified assets, AXA's business plan will see 72% of all in costs invested in the seed portfolio, developments, future developments, and renovation or repositioning of assets. So this plan will be executed in a highly competitive bidding environment and also in an evolving market where there remains uncertainty to some degree of where these next clusters of life science assets should be located. Lastly, there's not a formal cap on development exposure, though the long-term target is to reduce exposure into development to be about 30% of net asset value. So this is mitigated to much of a degree with the Cadence team has really demonstrated an ability to successfully source and execute development projects and is having a notable success in stabilizing its current development pipeline and projects. As an established partner or participant in the European life science market, with existing relationships with many of the institutions and the key occupiers that we're dealing with, Cadence is well positioned to really identify both resilient locations and secure superior investments in these locations. It has an ability to source, underwrite, and execute business plans, and its ability to really identify and manage any potential mistakes. This should also be further enhanced now by the ownership by the AXA platform. Lastly, and development is always, an inflated risk there, but a risk will be managed through the appointment of contractors with whom AXA and or Cadence has established or an existing relationship through either pre-leasing the space where possible and through the negotiation of a fixed price construction contracts. So maybe I'll close it here and hand it over to AXA, but the fund really combines a focused life science expertise with broad reach and experience of the two platforms working together. The strategy aims to really capture the expected growth in the life science industry and is currently fragmented but maturing in Europe. And for these reasons, we rated this as a buy rating for you all as a commitment today. So I'll stop here and hand it over to the AXA team unless we want to open up to any questions first.
Yeah, thank you, Seth. Why don't we go straight to Isabel Samama, and she'll start with the presentation from the general partner.
Thank you very much, and good morning. Thank you for giving us the opportunity to tell you about who we are and the European life investment opportunity we are proposing. So as it has been said, AXA is one of the largest insurance companies in the world with a AA- rating from S&P, and I am the CEO of AXA IM Alts, which is the alternative investment arm of the AXA Group. So AXA IM, in total, we manage $190 billion of AUM, and with this amount, we rank among the top 10 players in the world in alternatives. Real estate represents half of those AUM, and with such a portfolio, we are number one in Europe. Over the past years, we have expanded our business in the US, purchasing notably Quadrant, that is a $10 billion US real estate debt platform, and we are expanding our direct real estate portfolio locally, thanks notably to the acquisition by the AXA Group of AXA XL. We operate in the US from Atlanta and New York with circa 40 people on the continent. So I won't be long, but I would like to share with you our value proposition. In other words, how we differentiate ourselves within the asset management universe. First, what I would like to highlight is our ESG commitment. And ESG has been a focus for a very long time. You may have heard on the commitments made by the AXA Group, but if we focus on real estate, we have started to implement ESG strategies on our assets more than a decade ago. This long journey allows us to be very well set today, and we have, thanks to this long plan, a plan that has been designed asset by asset, portfolio by portfolio, and this allows us to deliver on very specific KPI for each asset, notably on carbon reduction. The second value proposition is that we are an integrated asset manager. And you have heard from Thomson that with this Cadence strategy, we intend to develop, so to grow the portfolio. But what is very important is that we have always have an integrated asset management capability, meaning that we are not just buying and selling the asset, but we have internally across 14 offices across which through which we invest, we have 330 investment professionals, including 170 real estate managers and 37 developers. And of course, this comes on the top of the Cadence team, and John will tell you more about Cadence. So this is a unique setup if we compare ourselves to other asset managers that tend sometimes to outsource those capabilities, but we really want to keep that internally and to perform asset management directly. And this is bringing a lot of value at a time where interest rates are low, returns are low, so being able to really create value at asset level is a strong differentiator. The first proposition is that we have a 360 approach, meaning that we are investing in equity, debt, public and private markets. And this is probably thanks to this approach that we have been able to identify the life science sector opportunity, looking notably at the US listed market. And so this allowed us to identify this sector and to be on time ready to sell on this Cadence opportunity at the time this asset class was less popular, as long as we have started to look and to discuss, to review the Cadence opportunity in 2019. And the last proposition is about alignment of interest. We pay a lot of attention to align interest of our different sources of capitals, and we pay a lot of attention not to create competition among our various investors. That's why Cadence has been underwritten by the AXA Group and is offered now to institutional investors. And we want those investors, we would like New Mexico to invest alongside AXA on the same basis. So we really want to not to create internal competition and really to pull all investors into on the same strategy and not to have parallel strategy run on behalf of different clients. So that is something on which we are very strict, and that I think is should be a very strong comfort for AXA, but also third-party investors. So I will now hand over to John, who will tell you a little bit more about life science and Cadence.
Thank you, Isabel, and thank you to the Council for the opportunity to present today, and also for the flexibility for working with us to such an expedited timetable. As a few things have already been said on the fund itself and Isabel around the AXA platform, I wanted to focus on the investment case for life science real estate in Europe and the investment strategy for the fund. Life science real estate in Europe is one of our highest conviction investment themes, and it is our expectation that this sector will grow significantly over the coming years, similar to what we've seen in the United States. The key drivers, in which have been mentioned already, include an aging demographic with increasing demand for healthcare, continuing advances in the science and technology behind the development of preventive medicine and therapeutics to address some major diseases, a rapidly improving funding environment in Europe at both a public and private level, notably venture capital, supporting the growth of companies in the sector, and an increased willingness for European academic and research institutes to collaborate with commercial enterprise. These drivers of growth are creating the need for life science companies to expand their businesses and hence real estate footprint. But this desire to expand is met with virtually no available high-quality lab-enabled space. This supply-demand imbalance creates a significant real estate opportunity through both the potential to develop new best-in-class space and also to benefit from rental growth and value appreciation through the active management of existing assets. The fund itself will immediately benefit from its investment in Cadence Science Partner, the leading pan-European owner, operator, and developer of life science knowledge-based real estate. The Cadence business has several attractive attributes. A sizable, high-quality, secure portfolio comprising built and rent-producing assets, materially progressed development projects, and several new projects under exclusivity, with a fully developed in excess of €1 billion. It also benefits from a pipeline of new opportunities to be funded with investor capital commitments, many of which are proprietary to AXA and Cadence because of their specialist life science knowledge. It also benefits from an experienced management team with existing relationships and experience in working with relevant stakeholders, United Kingdom and Germany, with planned near-term expansion to additional countries across Europe. AXA IM, with its network of offices and real estate investment and development professionals across the entire European continent and trusted market brands, will closely work with Cadence to execute this expansion. Based on the capital to be committed from investors, including AXA, we'll be able to significantly scale the Cadence platform and feel the combination of AXA IM and Cadence gives a critical first-mover advantage in this exciting and emerging segment in the European real estate market. I would make one final point on ESG, which is fully embedded in all our investment strategies. From an energy efficiency perspective, the existing Cadence portfolio scores very highly, with the majority of assets having an energy rating of A, and an intention for new ground-up development to be done to a similar standard and to the highest level of environmental certification. From a social and governance perspective, Cadence is highly experienced at cultivating ecosystems amongst its tenants within an individual asset and also across the portfolio. This ecosystem facilitates collaboration amongst a range of diverse entities, public and private, with the goal of fostering community and innovation. Thank you for your time again today, and we are available to answer any questions.
Thank you, John. Okay, any questions from the council members?
If there aren't any questions, Paul, I think that although this was every T was crossed and every I was dotted ultimately, and I think that because of the timing situation here, the committee really liked this investment. The fact that it's completely oversubscribed and we may not get all of the 50 euro. I think that this is a really positive addition. It's kind of side by side with the U.S. earlier investment in this space, and I think that this is important. Are there any questions by council? If there aren't any questions, let me go ahead and make this, put this motion on the table. Based on the recommendation of the Council Investment Committee, Real Estate Advisor Townsend, SIC staff, and general fiduciary oversight of RVK, I move that the State Investment Council approve commitment of up to 50 million euros to AXA European Life Science Strategy, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork. Do I have a second?
I second. This is Nick.
So it's been moved and seconded. Is there any further discussion? Carrie, would you please take the roll?
Certainly. Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Harold Lavender.
Yes.
Lee Rawson.
Yes.
Mike Messina.
Yes.
Nick Payet.
Yes.
Catherine Allen.
Yes.
And John Bingaman.
Yes.
That is 8 votes in favor, a unanimous approval.
Thank you very much, Council. I think this is a good one for us. For this next item on the agenda, I think everyone knows I work for C&M, and the C&M Ingenuity Venture Fund was an early investor in NTX Bio, which is one of the main holdings of, one of the holdings of the Anzu, one of Anzu's main holdings. I'm going to recuse myself from this. I can manage it, but I won't vote. And what I'll do is I'll ask Mike, if he will, when the time comes to place the motion on the table. Why don't we go ahead and turn this right over to David Lee.
Thank you, Mr. Chair. This is David Lee. I'm joined by Chris Cassidy, Private Equity Portfolio Manager, and also Richard Pugmire and Amy Ridge from Mercer, and finally David Selden, co-founder and managing partner of Anzu Partners. Chris will make some introductory comments. We'll turn it over to Mercer, and we'll finish it up with Anzu and open it up for questions. Go ahead, Chris.
I'll try to be brief so that we leave sufficient time for Mr. Selden to speak and talk about his firm. We're very excited this morning to bring a recommendation for the New Mexico program. It's a proposed commitment of up to $15 million to Anzu Industrial Capital Partners 3. This is a re-up. This would be our second commitment to an Anzu fund, the first being at the end of 2019 was a $10 million commitment to the Anzu second fund. Anzu is an early stage venture capital firm focusing on industrial and life science technology companies. They've invested in 2 local companies already, potentially in the reasonable short term could add a third. One of them is called Nature's Toolbox, which was founded out of technology created out of Los Alamos Labs. And the other is a Albuquerque-based company called BioFlight. Anzu really ticks all the boxes of what we're looking for managers in the New Mexico program, that they provide more than just capital local companies. Anzu's really set up its firm to help early stage companies deal with the challenges and bottlenecks that they face early in their lives. They've invested significantly in their investment and business services team in order to assist companies across a broad range of functional areas that early stage companies in the space typically need help with. I'll pass it over now to Richard from Mercer to discuss the fund in further detail.
Thanks, Chris. I'll focus on some of the investment characteristics that we evaluated, because Chris did a great job summarizing why we think this is a good fit for the New Mexico program. From a strategy perspective, a lot of the venture capital market has moved to a sole software focus, which has been a strong performing sector. But Anzu really focuses on broader technology opportunities and includes areas like hardware, materials, manufacturing systems, and life science applications, which does not have as much capital chasing the opportunities. And we feel like this fits better with the New Mexico ecosystem as well. Anzu has an experienced investment team and continues to expand the senior ranks of the team. The number of resources that they have are impressive for a fund of this size. They've really built a large platform focused on helping portfolio companies, which at this stage that they focus on are usually too small to get access to all of these resources themselves. And we heard stories from multiple CEOs about how Anzu's resources assisted across a number of different areas. They really utilize these resources to take an active investing approach, which is an important component of the New Mexico program strategy that we focused on, which is not just about the capital that they're investing in New Mexico, but also about the value that they can add to portfolio companies. The Anzu team has shown their commitment to this strategy by making a large general partner commitment, which is a strong sign of alignment with investors. The distribution waterfall also has a preferred return, which is a great addition because most venture capital firms do not have that. And one of our considerations is about potential long hold periods, which we see with early stage strategies in general. And the preferred return helps support alignment with regards to the hold period, as Anzu will be motivated to get capital return to investors. There's a number of areas of consideration highlighted in our report. I think the largest is around the track record, where there is a lack of realizations right now to really prove out the Anzu model. However, Anzu is still a relatively young firm, and it's common to have a lack of realizations at this point with an early stage strategy as companies take time to develop. We're also seeing an upward performance trend in the companies that they're holding, as they're starting to gain traction, and they've increased valuations from subsequent funding rounds. And we see this trend with Q1 performance being higher than Q4. We also looked at capacity concerns, as Anzu is managing companies in prior funds and will add new companies with this fund. Compared to other firms of this size, though, Anzu has more resources, so it's not really too big of a concern at this stage. And overall, we believe Anzu is a strong manager to have as part of the New Mexico program, and we're recommending an up to $15 million re-up to Anzu. 3. And we're happy to answer any questions, but for now, we're going to turn the time over to David Selden, who's managing partner at ANZU, for his presentation.
Thank you very much. Good morning, everyone, and it's an honor and a pleasure to be before you again. We deeply value our partnership with the state of New Mexico. As was just described by the staff and by Richard, we have now 3 portfolio companies in New Mexico. The third one that Chris mentioned has now gone live. It's a company called Mind Therapeutics, and interestingly, is a spin-out or a sister company of Nature's Toolbox, or NTX. It's a company that'll be operated both in New Mexico and Boston. But as an example of the type of thing that excites us, we've bought in that company the single most expensive piece of metrology equipment that exists through our portfolio. One of the things that we do at ANZU is encourage our portfolio companies to buy the best tools. And for our portfolio companies, generally that means scientific test and measurement equipment. The single tool that we've bought in this new company, which will be housed in our new facility in Rio Rancho, New Mexico, is something called a cryo-EM, which costs $2.3 million, a single piece of equipment. It's the single most expensive piece of equipment in our whole portfolio, and I dare say there probably aren't 20 of them in the whole Southwest, maybe not even 50 in the whole United States. So forgive me for going down that very specific example, but that's the type of thing we do at ANZU. We look to invest in complicated technologies. We've built a team of more than 50 people, including 12 PhDs, to be able to understand those technologies. We look off the beaten path. We're not snooping around Stanford's computer science lab trying to make investments only from there. Our typical investment is in Albuquerque, or coming out of Ithaca, New York, or in Denver, or in Iowa. We're scouring across the United States and Canada to find these early stage companies to be able to put your investment dollars to work, helping these companies move from invention into product. And that's at the heart of our strategy, and I think fundamental to what we've tried to work with your staff and your outside advisor on. We will never knowingly expose New Mexico's capital invested with us to science risk. For us to invest, for example, our investment into NTX, or Nature's Toolbox, we needed to see that the company had invented something, that the invention was intact, that we understood the intellectual property perspective, that we could see it and test it. In fact, when we diligenced NTX, we sent our team members to actually sit at the bench next to the NTX founding team and see the technology in action. What we do want to expose ourselves to in terms of risk, and be rewarded for it on behalf of our investors, is engineering risk. And by that I mean helping our early stage companies engineer their inventions into products, and products that will be relevant to the industrial world. And as Chris and Richard described, we have a very large team that deploys their time, in addition to the capital of our investors, into those projects. Just to give you a sense of what that means, since we've invested in BioFlight, our staff has put in 3,300 hours. That's beyond the diligence period. That's actual time of our people working hand in hand with the team to achieve the objectives of the company. In NTX, we've invested 2,100 hours, or dedicated 2,100 hours, and we would expect a very significant level of investment to happen also in Mind Therapeutics, where we're actively working on building that company even now. Let me pause there and defer to Richard or Chris if there are other things that you'd like us to emphasize, or if people have questions.
I think that was there any questions? Sorry. Any further? Yeah, no problem. Sorry about that. Are there any questions about this particular investment? David, Chris, anything further? Yes, Nick?
Mr. Chair, not a question, just a comment that I mentioned in the CIC meeting. And I just want to commend Steve and the SIC team, Mr. Cassidy, for continuously looking at opportunities that can not only benefit the the investment portfolio of the state, but also at the same time help with promoting and supporting New Mexico businesses. I know NTX Bio. I'm the CFO of Santa Fe Community College, and we had a really neat opportunity when NTX at its early stages came from Los Alamos National Labs to set up shop within our research park activities at the college. That, you know, under that policy, the state policy of the Research Park Act, we were able to, you know, work with the private sector, in this case NTX Bio, in a way where they could come onto our campus and partner with us. They were able to provide internships for our Santa Fe Community College students. They worked to provide Santa Fe High School mentorships. They provided summer jobs for UNM students, and they had employed over 15 New Mexico University graduates. And now we see them moving to Rio Rancho, and it is just an incredible progression of just the caliber of people that we have in New Mexico, and the you know, and the good work the LANL does alongside the higher ed institutions in New Mexico, and to have a company that's so interested in helping people and students' achievements and getting them skilled up is really incredible. I know personally this company, NTX Bio, is dedicated to New Mexico and improving, you know, lives in our state, and being very integrated within our state. So, and this is an excellent opportunity. I've seen NTX go from one lab on campus to 3 labs, and it is just remarkable with what's happening here. And so I just wanted to share that with the council. I fully, completely, 100% support this investment. And I really thank ANZU for you know, the work that they're doing within our state to help and promote state businesses like NTX and others. So thank you.
Any further questions or comments? Mike, would you please put the motion on the table?
Yes, but I do need help with the pro forma language on the motion. If you don't mind, I hereby move the approval of this investment, subject to, and this is where I need the help.
Let me say this, Nick, do you have the motions in front of you?
Mr. Chair, this is Member Romero. It'll help. I can read the motion.
Oh, that'd be terrific if you could do that, Debbie. Thank you very much. I know Mike doesn't have that in front of him, so that's perfect. Thank you.
Based on the recommendation of the Council Investment Committee, New Mexico Private Equity Advisor, Mercer, SIC staff, and general fiduciary oversight of RVK, I move that the State Investment Council approve commitment of up to $15 million to ANZU Industrial Capital Partners 3 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiations of final terms and conditions, and completion of appropriate paperwork.
Do we have a second?
I second. This is Nick.
It's been moved and seconded. Carrie, would you please call? Are there any further questions or comments? Carrie, would you please call the roll?
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Lee Rawson.
Yes.
Mike Messina.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
And John Bingaman.
Yes.
And Mr. Lavender, I've noticed your recusal, so that is a vote for 7 in favor of the investment and 1 recusal.
That's perfect. That's approved, and I think moving forward, I think that these kinds of investments are so important for us. No further questions about this. Let's move on to 3D. And just so everyone knows, I've been involved with this several times. Transition. When you transition into or out of a portfolio, it's touchy and it's risky and it requires a lot of skill. Starla has managed this a number of times, and I'll turn this over to Starla to give us a report on this transition.
Well, thanks, Harold. That is true. So this is Starla Bennett, and this memo is on diligence page 381. And this is an informational item. But we were very pleased with the ex-US public equity transition. We transitioned $440 million. This took place in May and involved 7 public equity managers. The total cost was $3.1 million, and that was within expected cost. Citigroup was the transition manager, and the transition included J.P. Morgan, SIC Accounting, and the SIC's public equity team. And I think the good news is that this completed the transition of the ex-US portfolio to the structure that was approved by the council in August of 2020. And those are all my comments.
Any questions? I just want to compliment you and the people with whom you work, because I know this is tough, and this is a terrific result. Any further questions here? Let's move on to 3E, which is the draft ESG policy, and I'll turn this over to Steve and to RVK to cover this. This particular subject matter has certainly generated an incredible amount of publicity and questions and comments nationally, internationally, especially nationally. And I think that it's important that we consider this. Again, this is informational today, and the idea would be after today, any input by the council would obviously be appreciated, and then we'll look to approve this in August. So, Steve, take it away.
Thanks, Harold. Just to reiterate how much we appreciate the good work of the staff and our consultants in putting our draft together. And with that, Marcia and Matthias, if you would please present your slide deck and your comments.
Well, thank you, Steve. But we have Becky Grantsinger, our Chief Executive Officer, who's going to take us through the slides today. I know you heard Becky present at another committee meeting, and Becky's going to join us today. Becky's been at RVK for many years, longer than I have the pleasure of working with Becky through the consulting, and she's been our CEO for the past several years, a dear friend and a great consultant. So Becky, I know you're on. Would you like to proceed?
Well, thank you so much, Steve and Marcia. It is an absolute pleasure to address the SIC today. I'd like you to turn in your materials to page 386 in our deck, and we'll start the ESG conversation and brief overview. I'll take about 15 minutes. Please feel free to stop me with any questions. I'll be listening carefully for any of those, and please interrupt me if you feel like I didn't hear you ask a question. So on page 386, we have a definition slide. What is ESG? This acronym has been getting a lot of press. And just to clarify what we mean by that particular term, it really is environmental, social, and governance factors in the investment decision-making process. For those that have been around the investment world for a long time, various types of investors, there are some terms that have been used in the past that touch on elements of ESG, such as socially responsible investing. Today you may hear terms such as sustainable investing or impact investing, screening, all kinds of terms. And there's a lot of topics that fall within each one of those three letters of the acronym. Under environmental, we've got a slide that just talks about various considerations that can be included in this label in a later page. But on this summary page, you can think about topics as wide as climate change to pollution or natural resource references. Under social, which has been certainly in the news a lot, as well as governance, we have topics such as labor standards, human capital, or stakeholder opposition issues. And under governance, board diversity is something that has been in the news a lot. But obviously, there's a broad umbrella there of topics that can be considered in governance. So ESG is a big tent. And as investors hear about ESG, it's important to recognize how broad it can actually be. If you move ahead to page 390, we actually give you a sense for who's participating in ESG. And this is a study that was updated most recently last year by FTSE and Russell. It was an attempt to try to measure by region and by size of large plans or large investors, whether they are participating in or evaluating ESG or sustainability. And as you look at the graphs on the left-hand side, you can see that there's a fairly significant portion of plans, whether they be under 10 billion or greater than 10 billion, who are considering these factors. In 2020, we did see an uptick across the board by both smaller, and it's hard to call plans just under 10 billion as small, but both under 10 billion and greater 10 billion. And the greater than 10 billion universe, and this was 139 asset owners who were surveyed, about 80% were considering these factors. And if you look at regions of the world, the North American region is catching up to some of the rest of the world. Europe has certainly been much more prominent here in terms of considering these factors. But in North America, more than half, in fact, almost 2/3 of large plans in the survey were considering these factors. So it certainly is becoming more and more widespread. Some of the things that are talked about with regard to ESG covered on page 391 is when you think about ESG, a lot of press in the past has kind of focused on whether you divest from companies that are doing things that are inconsistent with your values for ESG. So the old argument or debate about whether you should engage with companies to affect change versus just simply remove yourself as an investor. And that certainly is an ongoing debate. There are many very active investors that have been involved in engagement, trying to change companies and affect change. There are many more investors that have chosen to divest just because it's hard to engage in some topics. This particular slide actually looks at the fossil fuel industry. And in looking at a survey of whether engagement is more effective or divestment is more effective, in this particular study back from last year, most recently, you can see that certainly there are a lot of different responses, but engagement certainly, I'd say, is gaining a bit more traction in terms of things like proxy voting and other ways to have a conversation with companies that are perceived to need to make progress on a particular topic. So again, broad survey, 800 institutional owners, and we're starting to see engagement is certainly grabbing a foothold there. If you move on to page 392, we do talk about some standards that have been adopted in the industry or established in the industry. And one certainly is the principles for responsible investing that you may have heard about. There's pillars that have been established by the organization. There are a number of asset owners. In fact, about 88% of public asset managers have signed up with PRI to say we stand by these standards. and 89 or 88% of those actually claim that they do have ESG products. So this is something that has gained a lot of traction in the industry, is to say that you are a PRI signatory. There's a lot involved with that in terms of what's expected for organizations that choose to be a part of this, but we certainly see a lot of investment managers who have been considering this and deciding to sign up. There are some goals that have been established called Sustainable Development Goals, or SDGs, that were established by the United Nations and 193 countries that act as a blueprint for ESG investing. And those are things that some investors are considering, and it's a number of different values you may have seen in other publications. But they're really meant to provide a lens to filter investment decisions in the future and try to assess ESG impact. Another standard is set forth by the Sustainability Accounting Standards Board that is hoping to help the industry as we look at measuring and comparing companies on ESG factors. And this has been in place now since 2011. An example on page 393 of your materials of a particular report on ESG for a sample company is included. And this is just to give you an idea of the type of ratings that are issued by some of these firms. There are various topics that are evaluated and overall ratings. You can see at the bottom some of the scores, if you will, that this particular company had been given on some factors where they need to make some progress: supply chain and labor standards, labor management and governance. Where this company was sort of average is on the chemical safety front, and where they're really perceived to be more of a leader is in raw material sourcing and their overall carbon footprint. This type of data point is being used more and more by investment managers as they're assessing risks of holding companies, whether it be a stock or assessing whether a company will be in a good position to make good or honor their fixed income commitments. If you look at the next page, page 394, this is a great visual. If you're just thinking of a visual to have in your mind when you're thinking about ESG, we like this particular spectrum at the bottom, whether you're thinking about an investment management firm and where they stand on ESG topics, or whether you're thinking about a particular strategy that you're evaluating that's offered by a manager. And it really it follows the spectrum of being completely agnostic to ESG, where there's really no data used in ESG, either by a firm or a firm's product, all the way to impact strategies that really try to outperform.
Sure. Excuse me just a second. I'd like to remind everyone, if you're not speaking, please put your phones on mute. There's some background noise here that's interfering with what we're hearing. Thank you. Sorry, go ahead.
Oh, no problem. Again, we're on page 394 and looking at the spectrum of ESG. So it really ranges from firms or products that really are not considering ESG or ESG data, all the way through products who have kind of a dual mandate of trying to seek out performance and then also have a positive social good as part of the top priorities. And a lot of firms are somewhere in between, where they are considering ESG data as they look at the various risks they're trying to manage. But there are very few actually that are true impact strategies that are looking to balance those goals. So we think about this spectrum and we evaluate managers in terms of how much they are thinking about ESG and working this into their organizations, as well as the products that they offer. If you move to page 397, this we think is a very good page to talk about investment policy and integrating ESG into a portfolio. These are some ideas that we have seen clients consider on this page. The first bullet point, require an integration, ESG integration evaluation for manager searches going forward. Another one, and typically a first step that many of our clients have considered, is just look at reporting from their current managers to see where they are on the ESG spectrum and for the product that is managed for them. And then as you go through the process, consider drafting that ESG language into your investment policy. So these are some typical steps that we've seen clients take. And you can see an example of that language down at the bottom. So something to consider. And as you move to page 399, we've talked about what the definition of ESG is, how widespread it is, how to think about it in evaluating investment management firms and the products. So we wanted to give you a sense on page 399, how many products are there out there to consider? And this particular evaluation we put together by looking at the universe that we use for traditional asset class managers. So fixed income, equity, cash, other marketable strategies, if you will. And so when we look at that particular universe, it's the eVestment universe. The footnote tells you there's about 1,900 funds that are included in that universe. We actually see about 570 that are considered ESG. And when you look at the strategies with which those particular funds are managing or pursuing, the bulk of them are in equities, about 72%. Fixed income, there's some strategies available. Very few that are multiple asset class that we classify as balanced, having more than one asset class included. When you look at the domicile of those strategies, there's a lot in the equity categories as you look down that first column. About 63% are global or international strategies. So we certainly see a larger number there. It's more of an even mix in fixed income, balanced, again, more global. Under active and passive, it's possible to buy both. But in the case of equity, most of these are equity strategies, but there certainly are some passive strategies, and the bulk of fixed income are active. And then obviously for smaller investors, there's interest in, can you actually buy a fund that they can have sufficient assets to enter? And there are some that have decided to offer mutual funds. So hopefully that gives you a good sense for what ESG is, or the definition, and some standards that have been created, what investors are doing to think about how to evaluate managers and products, and then a little bit of a flavor for how many products are out there in marketable asset classes. And I'd also like to say here as a concluding remark that there are more and more ESG-related products that are being offered in illiquid asset classes. It's just a little bit more difficult to capture the data. So with that, it has been an absolute pleasure to be with you today. I'm happy to answer any questions that you have and turn it back to you.
We can. Are there any questions at this given point? And we can have a further discussion in a minute. Marcia, Steve, does that conclude this part?
Harold, I just want to thank Becky for coming to the meeting today, for making this presentation. Very clearly done and much appreciated.
It's my pleasure. Thank you so much.
Hang on, I got a few questions if I can, Harold.
You betcha. Go ahead.
With regard to the presentation, I'll have others on policy, but with regard to the presentation, I'm looking at page 5 of the presentation, and I just need a little help understanding. In the center column, it talks about human rights, and it says business conducted in conflict zones. I don't, right, and then it says that conflict minerals. So maybe you can explain to me a little bit more what you're trying to say. I'm not following.
Absolutely. Yeah, that one is a bit confusing. You know, one example of this would be, say, the diamond trade. And you may recall articles from years ago where there's, you know, certainly conflict about or concern about mining diamonds and the human impact of doing that. And so that's a good example that we were really meaning by conflict minerals. So does that help kind of clarify what we were meaning by that?
Well, not a whole bunch, but
well, you can think about it as when you're looking at the diamond trade in some of the countries where that particular type of asset is being extracted, there's certainly concern about both the labor that's involved, the influence of the companies that are coming into those countries to affect the diamonds, whether it is all being done legitimately. So there's been social concern about that particular trade, but that's just an example of a conflict zone.
I don't understand what a conflict mineral is. I mean, because I think you could argue that most minerals are going to have some sort of conflict. I mean, later on, you talk on page, or it's noted on page 8, which is particular concern to New Mexico, is the fossil fuels.
Uh-huh.
I mean, there's always a lot of discussion as to what is the role of each, mineral or energy source. But
right.
Would you consider the fossil fuel then as a conflict mineral or a conflict source, or?
I think probably you could say that it could be considered a conflict commodity if one is thinking about the aspect of the impact on the environment. And so that's where really the argument and the argument and debate has been, is many facets related to that. One is, the impact on the carbon footprint, the impact on the environment, the actual, if you think about ways of extracting that particular commodity energy, there's conflicts over the use of some techniques like fracking. So yeah, there's, depending on what investor is speaking, it can mean a number of nuances in that spectrum. But more recently, as we've looked at this, it's been a little bit broader, saying if you're concerned about the impact on the environment, then fossil fuels have been a real focus for that conversation. So,
Lee, I'm sorry. Lee, I think
go ahead, Marcia.
It's a discussion that boards and councils have to have, because it does, the discussion does depend on politics and where you live.
Yes.
I gave an example at the CIC meeting that earlier this month, the Maine Senate passed a bill to divest the state of Maine's investments from fossil fuels. The House has already approved it. I think the governor signed it this week or last week. So in Maine, state investments can't be invested. They have to divest from fossil fuels. Well, that's Maine. Then you talk about Texas, and it's likely to pass in Texas that there is a different issue, where Texas is going to prohibit many Texas organizations from investing with any manager that has banned energy investments. So completely different discussions in two states. Where, for example, investment in Texas, and some very large investment management firms have said they're not going to invest in certain energy investments. So now, like in Texas, there's a discussion of, well, we shouldn't invest with those managers, and it's going to affect, if it passes, several Texas funds, because some of the managers are big names. So we'll have to see what happens. But it really is a discussion about, every state, every area has a different perspective. Every individual has a different perspective.
Great example.
And we're further on that, and on the post-pandemic, there's notes to talk about diversity outreach and work within the community, and then responsive actions to social needs And I guess I'm trying to rationalize where such a policy is pushing a agenda versus what is best for the investors. Certainly, if we're talking about diversity within the workforce, that's different than diversity within the community. Because when we start having investments outside the business, then that's taking away resources from the investors. But likewise, you have to be somewhat of a good, public partner, I know as well. When we're talking about responsive action to social needs, I mean, is that within the organization? I mean, certainly, okay, now that we have some issues, do we need to provide some sort of daycare so that our employees can be attentive to work? Or is this responsive action to something outside the organization? So I'm trying to discern what the implications are within the organization and without the organization.
And therein, absolutely, you're pointing on something that makes this so hard, because every investor has to figure out what it is, if they pursue ESG, what is going to be the scope and what are the issues that they're recognizing. And the very things that you pointed out, for example, before the pandemic, there wouldn't be a lot of discussion about essential worker protections, but then that became a real hot button, obviously, as the pandemic was rolling forward. And the social needs, you are very, very correct in pointing out that where are you talking about? Is it being responsive to the needs of the community and wanting to support that, or focusing just on your beneficiaries or your internal employees? So back to Marcia's example, the interpretation of what's important to every investor, or the establishment of what's important to every investor, really starts with, number one, what is the first charge of an investor? Is it to support payments to beneficiaries? Is it to support an organization like a university? And then if the first priority, if the first responsibility allows further refinement by considering ESG, then what is important to each investor? And the answer to that is one of the toughest parts of considering ESG is, what is that policy for that investor? So that's where you get to trying to balance some of these examples that we've put in this chart.
And it is a tough discussion, because it's not just you as a institutional investor, as a group. You're a group of individuals, and all of us have different personal views, but this is a discussion for your institutional assets, and and like I said, it depends on politics, it depends on location, so it's an important discussion, and it's a tough discussion.
Well, then okay. Now let me just get down to one other issue as far as the presentation. It's on page 13, when we talk about strategic specific qualities. And it talks about ESG proxy voting process.
Mm-hmm.
And what that would, in my interpretation, is that basically the entity or the investor would be giving up its proxy vote to some group that has its own agenda for the ESG, which could differ from the investor himself.
Well, this actually, it doesn't have to be that particular outcome. In fact, some investors vote their own proxies to be absolutely consistent with their ESG views. Others give direction to proxy voting services to vote any specific fashion on their behalf, or tell their managers that they would like them to vote in a certain fashion. So it really is a decision that investors have to make, is do they want to do this themselves with their ESG principles in mind, which becomes very difficult for large investors like yourselves typically then that really becomes what kind of direction do you give to your proxy voting service provider and or managers to vote consistent with what the values of the board or the council is.
Right. And of course, the real question for the council is whose values should be represented. The executive's values, the legislature's values, the council's values, or the values of the people in New Mexico. And
exactly.
So it's really tough there to say, okay, we want to have these things. Now, certain policies certainly make sense, but some of the ESG initiatives are politically driven, and they're agendas that are, I don't think I don't think all New Mexicans would agree with. Where I do think there are ESG initiatives that all New Mexicans would agree with. So who determines that? And that's why I'm concerned with where we go with this. But thank you. You've answered my questions, and I appreciate it.
Absolutely. Our pleasure.
Any further questions? And by the way, Lee, I really appreciate you raising the issues you've raised, because those are essentially the same issues that I've had, and I know all of us have particular questions about it. Are there any further questions for Becky or for Marcia or Steve?
Mr. Chair, this is Tim. And
yes, go ahead, Tim.
Thank you. It addresses kind of Lee's concerns a little bit, but we've done an ESG investment at the Investment Council several years ago, if you remember, Senator, and it was actually a good investment for us to do with a good, proposed return. It was recommended by the council to go forward, and that's why I think it passed. And I think we can still do both. I think we can keep ESG in the back of our heads and also in the front of our minds. What is a great return for the state of New Mexico, and be able to make those two work together and improve not only our returns, but also our social conscience can kind of be taken care of at the same time. So I look forward to working with you on this as we go forward. So, and again, thank you for your comments as well. They're needed. They need to be part of the discussion as we go forward. Thank you, Mr. Chair.
And Mr. Chair, could I just offer one last comment? This is Becky.
Absolutely, Becky.
I would say the other thing to keep in mind, and this presentation was also trying to communicate that while investors are figuring out what kind of policies they want to pursue, that the investment management world has a grassroots movement going where they're looking at ESG elements as risk factors in their investment decisions. So it's both a top-down driven discussion, but also knowing that even investors that don't take an official position on ESG just know that a lot of data is being requested and used by many investment managers they may work with that's working that into their investment process. So it's kind of an interesting period of time to be having that discussion because it is a top-down and a grassroots discussion.
And I certainly think we're going to have to continue to talk about this and be aware of it. I'd like to go back to your page 11, or actually Diligence 394. You indicated how you felt about that page, Becky, and I feel the same. I think that's a terrific page. And I think that part of what we have to figure out is how to, integrated is the third choice, but how we integrate these particular parts of this into what we're going to do. And to that end, I'd like to ask Steve to give us your opinion about how you would like us to handle this over the course of the next 2 months before we come back together in August.
Harold, our thought would be to delegate the discussion to a committee and have the committee make a recommendation to the council and then have it discussed in more depth at the council level, or to have the entire council engaged in the discussion. Those are the only two alternatives that come to mind.
think that, at least off the top, I think the whole council should be involved in this. I think that it may be a little bit of an unwieldy discussion, but I think we should do it. Will there be, are there plans to create a draft policy prior to the discussion? In other words, New Mexico SIC ESG policy. Is there
yes, Harold,
to draft that document?
Yes, we do have a document that we have prepared. I know most people have not had a chance to go through everything in the materials, but you will find it as item 3E, draft ESG policy.
Right.
But Steve, what would help? It's very to read all of this on online, on the site. So could you email to all of us the presentation that was just done, but also the draft policy, so we can, if we want to print it off and look at it that way? It's really hard to read and edit, in the on the site.
Of course it is, Kathy. And Carrie, would you kindly do that for the council?
Certainly, I'll go right now.
Terrific. And the document, going back to the beginning and looking at the document itself, I can see we're going to need to, I think, have a very good discussion about this and leave plenty of time to be able to talk about it and determine exactly where we're going to be. Are there any further questions, opinions, thoughts about this particular area until we bring it back in August?
Oh, yeah, this is Lee.
Sure, Lee.
With regards to the specific policy, because I thought that's where we were going next. So I was trying to separate my discussion in terms of the presentation versus the draft policy. And where I do know that we passed a previous, ESG program or investment, I did vote against that because I do not think that should be the determination of why the council should make the particular investment. We haven't had any specific reporting back as to how that investment is doing, compared to others in the asset class, and why that was a good thing. Yes, maybe there's things that we can do that affect, both ESG and our investment. Maybe you can do both at once, but, really what is our responsibility? And I would say, first of all, if we're going to be concerned about ESG issues, if we think that's our role, it should be our role first in New Mexico. In other words, we should be concerned about those social issues and impacts in New Mexico rather than what those social impacts are in Asia or Africa or Middle East or wherever we're at. So I think we have to look at the priorities. And I think, if we wanted to say, hey, we're going to put this in the New Mexico program first, and then you would argue that, well, the problem with putting it in something like the Mexico program is small startups aren't going to have these types of initiatives. So you can go back and forth. But if we look at page 32 in my packet, the first page on ESG considerations, I would feel more comfortable if the legislature, told us through legislation, not just by memorial, but through legislation, that our responsibility is to consider these things. They are the ones that represent and are chosen by the people of New Mexico, not each of us. So if this was coming from the legislative as the legislative action, I would feel more comfortable on it. Because when we look at our responsibility constitutionally, is to maximize the risk-adjusted return. Now, all things equal, if we're going to get the same return out of various investments, then we could choose, some priorities over another, or some determining factors. But let's just say on number 4 with the implementation consistency of fiscal responsibility, it says it's our duty to manage and invest the assets solely in the interest of the beneficiaries and for the exclusive benefit of providing financial benefits to the beneficiary of the assets. That's our constitutional fiduciary responsibility. So I would like, when staff comes back in August, I would really like to have, prior to that, some sort of legal analysis in terms of what is our fiduciary responsibility, and how does this really fit in, and not a politically driven document, because we all have our perspectives. But I'm really looking for what is our proper role, because if we're going to sacrifice, for instance, we know that we sacrifice return by investing in ETC, economically targeted, what do we call them, ETIs. So if we're going to do that, we're going to sacrifice return. Well, I would think that the policy here should clearly be that we're not going to sacrifice return. But I think if we're going to have a policy, there's some things that maybe don't need to be said that become more lightning rods. For instance, on the environmental considerations, we got it in brackets, and maybe we don't need to be listing all those things, because when you talk about climate change, that's going to become a lightning rod. We talk about treatment of animals. Well, I don't know how that affects most of our investments, unless we're involved in a meat processing plant or something. That doesn't need to be there. Social criteria talks about philanthropy, and I think philanthropy is up to each of us as individuals. But when a company is giving away philanthropy efforts, if we're not careful, they're giving away our investment income that's due to our beneficiaries. So I'm just concerned about that. On number 4 on the next page, right in the middle, it says ESG factors which can present material business risks or opportunities. That's a pretty broad statement. And I think we are concerned about the sustainability of an individual company. That's the main thing, is we want to make sure our investment is sustainable. And, but in terms of what really is the risk and the opportunity with some of these considerations, that's going to be, depending on how you look at fossil fuels. Is that a risk or not, as we see things changing? But New Mexico is highly invested in fossil fuels, so we should be very careful with what we say there. But as we invest in other alternatives, what are the risks, right? But some of those issues in environmental considerations, or even the social criteria, they don't really pose a risk to the individual business. We might think it poses a risk other places. Then in number 5, I would also suggest where it says the SIO may take any of the following actions. I think it ought to be more clear and say the SIO will take the following actions. But I would certainly strike out the bullet that talks about the third-party broking, proxy voting. I think that's a decision that the council should have, and shouldn't necessarily be in the policy. That might be something that we want to enact and have our managers deal with, but I don't think it should be in the policy as a may, and I don't think it should be in there as a can. But I hope that the whole section should be a directive to the SIO as to what we expect, and not what he may do. We would expect him to counsel with us. We would expect him to consult with external investments. We would expect him to recommend policies, right? So I would suggest those changes preliminarily, but I would like a legal analysis of our fiduciary responsibility. And that's all I have, Mr. Chair.
Lee, I really appreciate what you've had to say. I think that you're really highlighting the critical issues here. And I think that obviously we can't get a legislative mandate or directive prior to at least January. But I think that you've raised the kinds of issues that we need to have and that we need to talk about. This isn't simple. and it will continue not to be simple. And I think that this is a good start. Steve, why don't you?
Can I mention one other thing, Harold? Maybe
Absolutely.
Maybe the first step ought to be a letter from the council to the legislature asking them to address it specifically as to whether or not they want us involved, and if so, to pass legislation. Because then we'll know going into, 9 months from now, we'll have something in place and we can run with it. I just think we're running outside our authority. And I know what the legislature will probably say, which is fine, but that should be their decision, not ours, in my opinion. But what I would recommend is sending a letter to the legislature telling them, start talking about it at the interim committees and give us direction.
Okay. How does the rest of the council feel, please?
Mr. Chair, this is Mike.
Mike.
Yeah. Well, with due respect, Lee, I think it's a bad idea to send a letter to the legislature. We don't need legislative direction to take these things into consideration. What we need to do, in my opinion, when we take these things into consideration is not to forget our primary obligation to maximize returns. And I think you can do both. But I don't think we should ever do anything that sacrifices the level of return we get, because that's our main responsibility.
And I think therein lies I think Lee's highlighted, and you've highlighted the idea that's kind of the conflict. And I don't think you can really call it anything other than a conflict, and that is the return versus ESG. And how do we integrate the two? Steve, your thoughts.
Harold, I don't
yes,
think
Mike.
I don't think it's necessarily a conflict. I do think we have a constitutional obligation to maximize returns, and we can never forget that. But we can take into consideration ESG factors without sacrificing that. It doesn't mean they'll dominate the decision, but as long as we're consistent with our obligations, we should be thinking about these broader issues, especially because some of these broader issues, to me, are the kinds of things that might invite litigation in the future against some of these funds. Could have a negative consequence. But anyway, I don't think we need special legislative action or can even hope to get it. Because I don't expect them to agree on it.
Mr. Chairman?
Yes, John.
John Bailey. Yeah, I just wanted to strongly concur with Member Messina's comments. I do think a lot of what's being proposed is really just taking some of these factors into consideration. I think is part of, frankly, us just being good fiduciaries and taking all risks into account when we think about these investments. That's what good investors should do. So I would concur. I don't think there needs to be a conflict between taking these factors into account and achieving good returns.
Thanks, John. I think if you take a look at the implementation part of the number 5 on page 383, it does make it very clear that what the SIO will do relative to investments in the future. And I think that if you look at that really closely, I don't think there's anything there that potentially causes problems. I think it really says we're going to consider these factors, we're going to pay attention to them, and we're going to integrate this into our thinking about investing. Any other comments by council members?
This is Kathy, and I agree with that. I feel like it's appropriate risk management for us to be taking this into consideration, especially when so many large investor groups, like BlackRock, are talking about not only the greater returns with firms that practice ESG, but also that it's something that investors need to pay attention to. So we're doing our fiduciary responsibility by taking this into consideration when we make investments.
Thank you, Kathy. Anyone else? Well, I think based on the way this was presented and the way it's set up, we'll take this up in August. Steve, your thoughts? Does that work, and does that go with your ideas?
Yes, it does, Harold. And we will give some thought to the request for a legal analysis. I'll discuss that with Bruce and Evan. And if we can come up with a memo to the council covering that topic, we will. I think this has been exactly the discussion we had hoped for, and we'll look forward to continuing it in August.
I appreciate that. And I do look forward to a memo or more information. And I think if you want to, even though we're not going to meet in July, any communication with us between now and the investment committee meeting in August, it could be really appreciated. Anything further on this issue? Okay, let's move to 4, finance matters. Brent.
Mr. Chairman, I'll be really brief since Steve already addressed some of the topics I was going to address. I'm on page 400. Just a couple of things to point out. This is because there is no council meeting in July. The last report on budget to actual that you'll see, other than through the audit report that will be done. No budget problems anticipated through the end of the fiscal year. I've also, as I've always done, included the May IHR, which is the Investment Holdings Report. I did review a draft of the agreed upon procedures report from Moss Adams yesterday. I would expect that to be finalized and sent out to the council by the end of June, which is the deadline for Moss Adams. Other than that, just wanted to emphasize to everyone in August, we will be in fiscal year 22, which is a new fiscal year. So you will be seeing a new budget to actual schedule for the new fiscal year. And unless there's questions, I have nothing further, Mr. Chairman.
Council, any questions? I would like to simply add my congratulations to Brent and his staff. This is a big deal, and they do a terrific job. So thank you. Anything further here? Let's move to number 5, closing matters. Any new or old business? The next SIC meeting is Tuesday, August the 24th. We've got an investment committee meeting, I believe, on August 12th. And obviously, as we always do, would like to implore council members to join if you have the time. Public comment period. Charlie.
Mr. Chairman, we do have one public comment that was submitted to the council today. This is from George Richmond of Albuquerque. His comment is, the NMSIC has an extremely successful record in managing public funds. As the results are better than that of both state pension funds, I recommend that the governor, that the SIC manage both pension funds. This will require a change in state law, so please review and consider adding this to your recommended legislative issues for the 2022 meeting of the state legislature. George Richmond.
Thank you, Charlie.
Just for context, I will mention that this very subject was raised by Representative Bill Ream yesterday, and so it will be a discussion topic at IPOC.
Anything further? Well, I'd like to thank everybody for your participation today, and tell everybody that have a good July, and we'll look forward to hopefully being able to see everyone in person in August. With that, let's adjourn. Thank you.
Thanks, everyone.
Thanks, everybody.